of the market close. This is the last market close for the month of July as we are ending out the month, and it obviously has been a crazy month. We've actually had a relatively crazy day in terms of some of this price action, and it's very nice to see at the close, finally, NVIDIA participating a little bit. 201. There's no headline I can give you for NVIDIA here. It might be an end of month rebalancing that's happening right now, which tends to happen towards the end of the month anyway, which is why some of the semi names might be taking a little bit of a hit right here. Micron down 4%, CoreWeave down 2.5%. The S&P 500, look at this. We are almost closing in on 750, folks. And 763 or something was the all-time high. So we are not that far away from all-time highs. And the reason we are getting this boost of momentum right now, it's because of NVIDIA as we get right into the close. But really, the main culprits for the day are Google with a 7% move, because there's no way in hell Amazon could go up 15% on the day, which is, by the way, when's the last time Amazon's had a 15% day at this magnitude, almost $3 trillion market cap? Obviously, the street liked the CapEx, the street liked the ROI, the street liked the explanation of why Amazon is winning when it comes to the cloud. And as a result, you can't really deny Google's 82% growth. So you have the big three, Amazon, Google, and Microsoft. Microsoft also up 2.5% of the day. Microsoft was $380 last week. It's now $462. So the three large caps that really haven't participated throughout this year, chat says you're streaming again. I am indeed streaming again as we end out this month of July. And the way we're ending it out, although this month kind of sucked, is just better, in my opinion, than when we started it, at least from the Mag 7 perspective, because they actually delivered earnings. They delivered the CapEx that was necessary to help the semis, even if the semis aren't really reflecting that right now. And even Tesla right here getting up 1%. That's helping the S&P 500 get back to all-time highs. So the momentum-driven drawdown that we experienced in July, I don't know if we're necessarily done with that going into August, but we definitely have made some inroads into thinking of the broader AI story in a different way, especially because the hedge fund blow up, if that was kind of the core culprit of why we had so much of the pain, at least the more egregious nature of that pain. Nebius right there going green. By the way, someone bought 5.2 million of Nebius calls today. $200 strike expiring in October. Then maybe that's the worst of it, and hopefully August is going to be a little better, which is important right here. Nebius 189.23, as that is green on the day. Chad says, kind of sad you call Chris ad hoc and not me. I feel like I've done that before, Chad. But okay, randomly, I'm going to call Chad and have him join the show. We definitely did that before. I sent you a link randomly on StreamYard, and you came through. But it's been too long, so we'll get Chad on the stream next week, and hopefully he can give us some more insight into this institutional sovereignty stuff that's going on with Palantir. In fact, you got Palantir right here, 123.23. We got earnings on Monday. It's going to be a big one. We're going to see what Palantir can report. That's up 0.78% on the day. Some of the software names are still relatively red on the day as the semi names have gone up a little bit. But a bunch of the semi names are also still down. AMD went from 515 back down to 484. So you did get a bit of a rug pull towards the beginning of the day, around 20 minutes after market open, on the semi names, especially the memory names. But all in all, they're still doing a lot better than where they were last week. Many of them kind of breaking even or slightly green on the day. ARM up 0.22%. Intel, that's up 0.5%. NVIDIA really coming alive as we get towards the end of the day, which is nice to see. Now, Leopold, we have access to his letter, folks. We got access to his letter. It was officially put out today. And I want to read you the letter. I think the letter is relevant to read. We've been talking about this story for the past couple of days now, and the story is obviously very, very important. And, you know, my take on this was, again, the guy is very smart when it comes to figuring out where the trend is going. He just got a little too greedy with the leverage, right? And it happens to the best of us. I think the way he articulated himself in the letter was a very respectful and appropriate way to navigate this drawdown. But nonetheless, you know, he confronted the reality of what ended up happening. So here is what Leopold had to say to his investors. Dear partners, we let you down this month. We came closer to a permanent capital impairment that is acceptable to us. While we ultimately found a solution that protected the fund and you as investors, our intention in running the fund is never to find ourselves in such a position in the first place. Volatility is the price of long-term investment returns. Over the past 2 years, we have delivered outstanding results despite occasionally sharp pullbacks, but our fund must always be structured such that we can't take a loss and fight another day. I will make it my mission to ensure that we learn the necessary lessons from this experience. Here's where things stand. The portfolio experienced a significant drawdown over the course of July, which was exacerbated by extreme concerns in core positions over the past week. Many AI names drew down by half or more, while our positive long-short spread reversed violently, aka software went up, semis went down. So we now have confirmation that Leopold was shorting the software names, which means a lot of hedge funds are doing that as well, which is why all this software FUD that's out there, it's all nonsense. It's all BS. It's all manipulated, manufactured stuff by the hedge funds that need to protect their long semi trade, which is why I think the software companies will be good in the long term, and we'll have sustainable earnings growth and get out of this funk that they're in right now with the semis. While we could say much about how unusual the month was, we hold ourselves to a higher standard irrespective of market conditions. As these moves proceeded, we started to see increasingly adverse trading in the names publicly associated with us. These dynamics are essentially similar to a bank run, vulnerability begetting more vulnerability. We worked together to keep the portfolio with our risk parameters, but gradually this became more difficult as positions rapidly moved against us and market liquidity dried up. On Wednesday night, Thursday morning, we took decisive action to protect LP capital. We traded a portion of our public portfolio in a block transaction to remove all leverage from the fund and prevent further losses. That's where Citadel came in. All shorts were closed and reliance on portfolio financing removed. We currently manage a fully paid for public book, long stock and long fully paid for options with no margin liquidation risk, meaning they still have equities in the public markets. It's just probably not at the level that they had before, but none of that is on leverage. This restored stability and allowed us to preserve our private positions. I take full responsibility for these events. To be clear, this should rightly have been a very painful month in terms of the performance of the fund. When AI stocks draw down dramatically while AI technical business fundamentals are improving, you should expect our fund to be down a lot. We embrace volatility, but it should never jeopardize the fund. The fund was not shut down, liquidated, or transformed into a private-only fund. We are continuing to operate as a hybrid public-private fund as before. However, we will manage our public book on a fully paid-for basis while we draw the lessons from these developments, aka we're not going to be using leverage and margin, which means the gains that Leopold tries to get, he's going to have to really find the right names, because you can't exacerbate those gains with leverage, because they're not going to be using leverage anymore. And we don't know, how many billions he's actually playing with now in the public markets. Most importantly, we took the steps that were necessary to fight another day. In the coming weeks, I will focus on putting in motion the necessary changes across our portfolio management, risk team, and vigilance applied across the board to ensure a higher level of resilience going forward. AI may continue to intensify market volatility for years to come. These were very expensive scars, but I am dedicated to ensuring that they will be invaluable lessons for our organization, for myself as we move forward. My core promise to you is that we will not waste the opportunity to learn from these events. On the portfolio itself, we are very optimistic about the current investment opportunity set. The underlying fundamentals are accelerating at the very same time that prices have declined significantly. Thank you for your patience and partnership. I'm fully invested alongside with you. Virtually all of my capital is in the fund, and I intend to work relentlessly to just demonstrate that the events of this month have made me a wiser and stronger investor. I'm available next week for one-to-one phone calls. As an interim update, our current unaudited estimate of our month-to-date performance is negative 67%, and of net year-to-date performance is 80%. We will follow up. We're going to group call next week. All the best, Leopold. So what do people think when you hear that? What do people think when you hear that? Is that kind of like, all right, there's a level of maturity there, responsibility for your actions, accountability, NVIDIA 201.39. Or do you think the guy's full of shit and he just got caught with his pants down and now is trying to make up for it? I mean, the fact that the fund is still up 80% year to date. Now, if you invested at the top, you're not up a lot, but many of those investors came in years ago. Micron really getting hit right at the close. This memory trade, again, has not gone the best this week, along with the NeoClouds, but giving up a lot of the gains from the pre-market. But I don't think this guy's gone. I think he will be back and he will be continuing to do what he wants to do. The problem is, those gains really happen because, if you're playing with 5 billion, but you can use 20 billion, you can start to really get some market momentum. If he's only playing with the few billion that he has, it's hard to get upside move, even if you're in the right stock, because the leverage is what magnifies it. And so not sure how the performance will continue to accelerate to the, sort of astronomical 439% returns that he had. But it doesn't seem like, as long as this AI story is intact, the performance has to dissipate too aggressively from the core positions that he ultimately has. Shopify right there down 4%. Monolithic Power, that was up 9%. And the Nebius right here, again, slightly going green as we get into the close. Reddit, I've read a lot of commentary today about Reddit, the consensus. I bought Reddit at 147 today. So averaged up on my position. Average was 143. Stock got to a low of 135. Now it's at 140. I've read a decent amount of commentary. I continue to believe that this is a really stupid sell-off, and the street is upset about search referrals going down. I'll dig deeper into the weekend on this to try to articulate the bear case in a better fashion, but the earnings estimates are just too cheap on a name like this that's growing the way they are growing, and that's projected to continue growing. I think if you disagree with the projections of their growth based on the bear case that has been putting out there, then yeah, stock probably should be down even more than 20% right here. But I think it's a bit overdone. I mean, realistically, missing on the users and the search stuff should have been down 5%, maybe 10%. You want to give it 15, sure, that's a bad day. 20%. At one point, it was almost 27%. Like that's a bit overdone. And Google was down 10% last week. Google's now recovered all of that and now up 7% in a day. Like the market is moody. I think we've absolutely seen that to be true over the course of the past month with momentum. So I think Reddit will be fine over the long term, but it did get hit today. NVIDIA right there, 201.80, as that's continuing to get some love as we get into the close. By the way, this clip has been going viral of Leopold in his only podcast that he's ever done. And my question for everybody is, if you heard the guy laugh like this, would you give him money or would you not give him money? Low key, I think I might give him money if I heard this laugh.
That's the short summary of my post or my view on the project.
Maybe I kind of relate to how he's laughing. So that's I mean that's part of the reason I might have given him money 2 years ago if I heard him laugh like that. Wall Street Journal, Citadel agreed to buy most of the public portfolio at a discount of more than 10% to market value. Okay, so they were already getting a 30 to 40% for some of those stocks, 60% discount from where the stocks were trading at their all-time highs. Looks like they got another 10% discount on top of it. So if Nebius was trading at 140 at the lows, they might have got it Nebius at around that 125, 130 range. Again, Nebius was down from 300. Nebius is now at 190. So Citadel made absolute bandits right here on this trade. A lot of people were thinking they ended up selling their positions today just because those stocks went down. Maybe Citadel unwinded some of these positions in the bounce that we're seeing right here. Or maybe they think a lot of these AI momentum names are eventually going to get momentum swinging back in their direction. And eventually when that happens, they should hold on to these names because they'll do well. So time will tell to see how this ends up playing out. But what a month it has been. What a freaking month it has been. We've got 30 seconds. AMD getting some ugly candles into the close. Officially just went red. I wouldn't read too much into it. I think it's end of month rebalancing. We got 20 seconds left to end out the entire month. Obviously, a lot of these names were down way more earlier in the week. So the fact that they even got that recovery from yesterday, I think is the most important thing. But it's nice to see the Mag 7, NVIDIA, Google, Microsoft, Amazon, the big names. Even NVIDIA, look at that, selling off a little bit right there, 201 to 200, 202 to 200. But still nice to at least see them get some of that love. Here we go, Friday, July 31st, 4 p.m. We are done with trading for the month of July, and the stock market is now closed. All right, that is it. What a July. What a freaking July that we all had to experience. But nonetheless, we experienced it. NVIDIA, 200.75, up 2.93% of the day. Nebius, 190. That was up 1%. AMD got that dump right at the end of the day. 476, down about 1%. Google, massive move today. $4.36 trillion company again. That was up 6%. Micron, that was down about 5% of the day. CoreWeave was down about 3%. S&P 500, 746.90. Again, not that far away from those all-time highs. So it was nice to see the S&P start to come back a bit. Even Meta, dude. Amazon did so well that it helped Meta get back from the 520s. 556.71 on Meta, up about 3.31%. CrowdStrike was up 3%. We talked about that Anthropic Mythos stuff that came out in the morning. Robinhood, unfortunately, got the end of month dump right there. It actually got up to very close to 90, as you can see at that last 10 minutes of the day. Yeah, there you go. Dropping about $4. That seems to be some of the rebouncing. ServiceNow, that was up 1%. Astera Labs, that was up 3%. Marvell, that was up 2%. It was up a lot more in the day. So again, a lot of those semis still got hit towards the end of the day. ARM ended up going red. Intel ended up going red, down about 1%. UNH was down about 1.72%. Oscar flat on the day. And then Reddit down about 20% on the day as well. This is what the month of July looked like if we look at it from a month-to-date perspective right here. And as you can see, there is a bit of green, which helped the S&P 500. It's just the parts of red that you're seeing are very aggressive parts of the red. And a lot of that was, essentially the semiconductor trade. So what did we deal with in July? Momentum at its worst month in 20 years, but got a slight recovery towards the last couple of days. One of the largest AI funds, Leopold, lost 67% of its value. The Fed didn't hike rates. Amazon, Google, Microsoft proved that AI is bringing an ROI, which is why the CapEx will continue. Financials, insurance, energy, healthcare have a great month. Oil spikes 15% due to what Trump said around the escalations with Iran. Kospi ended 20% for the month, but it was negative 40% at one point. It got most of that 20% back yesterday, which is, again, just crazy. And that is how the month played out. It was obviously a dramatic month. Now we've got NVIDIA left for August to hopefully give us some more love. But man, what a crazy month to live through in the stock market. SpaceX was down 3.41% of the day, 108.37. Your space names in general kind of had a tough month, obviously with SpaceX getting hit, but Rocket Lab right there still closed above 60. It was actually below 60 the other day, right? Like, again, some of these egregious prices. And so it's good to at least see some of those get the rebound and somewhat get a bit more recovery. GE Vernova, that was down up 0.283% of the day. Palantir ended 123.06. As that was also slightly green here today. But nonetheless, this is what we had for the month of July. Nebius again, 190. Oh, Apple, by the way, this was just, again, it was kind of crazy. Apple was down 10% at one point. As you can see, why was Apple rallying into the last 5 minutes of the day? Because the risk on stuff were selling off into the day, right? So Apple was almost going below 300. And again, I don't think Apple really should have ever got to 340. Like, it's Apple. So when it gets there, people are like, well, it's Apple. But it's also like, dude, like, people were buying it because the AI trade started selling off. So as Apple sold off today, which, by the way, a lot of that sell-off was based on memory price inflation as well, which is weird that the memory names didn't go higher. But nonetheless, it's probably more reasonable for Apple to take that 8% hit and kind of normalize around that 300 range. And that's what we have for July. Roblox also lost 27% today. Biggest one-day drop on record for Mr. Roblox. As Amazon Amazon had its best day since 2012. So Microsoft had its best day since 2020. Yeah, so 15% on Amazon, haven't seen it in over 10 years. That's crazy. For Microsoft, it's 6 years. For Amazon, it's over a decade since we've seen a 15% day. We had Chris Camillo on the show in the morning where he said, by the way, Chris will also be on the show, Christopher Patel. Let me make sure to send him the link right here. He'll be on in about 20 minutes and we'll get his take about what's going on. But Camillo said it was his best trading day that he's had in his entire life. So it was one of those days where if you were heavy in Amazon, obviously you got some love. Here's what Trump had to say earlier about Iran.
The status of talks. Who from the administration is talking to the Iranians?
They break their word so often. Steve is talking. Jared, they're very good people. JD's involved, very strongly involved. We have great people talking. Marco's involved.
Because they say talks aren't happening.
They're good people. They're the best people. But they'll make a deal. As an example, we'll talk about nuclear. And we'll be in there talking about nuclear for 7 hours. I say, why do you need 7? You can take 10 minutes. Yeah, 5 minutes. You should solve it. But 7 hours. And then they'll go out and I'll say, they discussed nuclear. And they'll go out and they'll say, we never discussed nuclear. And I say, why did they say that? All they do is make me angry.
All they do is make me angry. Again, some of the disclosures or some of the sort of vocabulary that we got from Trump here, again, it just wasn't something that you would see from a de-escalatory perspective. And then, they asked him about attacks and, it was kind of interesting because Trump was blaming some of the stuff that's happening from a cybersecurity perspective on Minnesota versus Iran in terms of different things that are going on.
Can you rule out that Iran is behind the water attacks? Can you rule out that Iran is behind that cyber attack? You don't think so?
I think Minnesota is behind it. You know who's behind it? Minnesota, because they're grossly incompetent. I think the governor's behind it. I don't think there was an Iranian cyber attack. I think that Minnesota ought to get its act together. It's one of the worst run states. JD will tell you. we found tremendous corruption in Minnesota. And by the way, just gave me a report, massive future things having to do with corruption in Minnesota are happening right now. Thank you.
So we didn't really get much from the from the meeting. I was trying to look for some more clips and stuff that he said that we could kind of latch onto or try to understand. And oil ended up spiking today, another 2%, 84.80. But the most we got was this Minnesota thing, which I don't even know what he's talking about there. And then him just saying that Iran makes me angry. So yeah, we didn't get much from this. They asked him, how do we revive the ceasefire? And then Trump answered, we just want to win. So it doesn't look like that ceasefire, especially with the Iran attacks from 2 days ago in Jordan, are necessarily going to change anything. But regardless, I wonder if the market is fully caring about the oil stuff, or, you know, they're trying to more meaningfully trying to reconcile what's going on in the semi trade and figure out if the semiconductor names actually deserve a premium. Palantir right there down a little bit after hours, 0.13%. Put in the chat if you bought or sold anything today. Again, I bought some Reddit. Well, that was pretty much it. So you can put in the chat if you made any broader moves today. If you sold any of the stocks that you might have bought on Wednesday, because obviously those would be up a lot as we've ended into the week. Oh, we just got something right here from our girl Caitlin, who is close to Trump, from the New York Post. She just tweeted, President Trump previewed upcoming military strikes on Iran during the cabinet meeting. Following reports, he has a range of options at his disposal, including a 2-week campaign to target Tehran's remaining missile capabilities. Trump said that the U.S. had obliterated much of Iran's military capacity. He's been saying this for a while. The reported CENTCOM plan would be a sustained strike campaign rather than a limited retaliation. Its aim is to substantially reduce Iran's offensive missile capacity. The key constraint is munitions, which we've talked about before. It's part of the reason why he wants that $1.5 trillion budget. One of the generals reportedly warned that a broader operation could further strain U.S. air defense interceptor inventories, which is, you know, to be honest, also some of the issues we're having with oil. We do not have enough in the SPRs, and if we're low on munition and oil prices are rising, definitely not the best situation, which is probably also why they haven't launched, say, massive offensive attack, just because they need the military equipment to actually continue to execute on this. Microsoft right there up 3% again here on the day. So again, it just goes back to escalation. And I think in the month of August, which again, the stock market doesn't really do well in August. Last August was a little bit of an anomaly because we had a couple bad few days, and then August ended up doing really well. So did September, but that's why October and November sucked. Usually it's the opposite, which is why you get the Santa Claus rally. So if we do have a crappy August, I think it will create a buying opportunity, but going into the midterms, we've got to see how much the market actually cares. I see some ads to SoFi. I see some ads to Palantir. I see some ads to Zeta. I see some Reddit. See some Metas. Sold Microsoft, bought Reddit. I see some CoreWeaves. Circle, which got a pump with the Clarity Act expectation, but now that that expectation is kind of in the gutter, Circle's been traded off as well. That's down 3% on the day. Chamu said he got some NVIDIA at 195. I see some hoods. I like Hood here, dude. Hood under 90 after those earnings. If August sucks, then, you know, Hood's probably going to go down with the broader market. But like fundamentally, if Q3 is going to have similar trading volumes to Q2, Hood at these levels kind of feels like a move back to 110 is not out of the question right here. See some Blooms. Rushiel added some Meta 2028 spreads. Maybe, you know, the Amazon options have worked for people. The Microsoft options have started to work for people. Google options have done well. Meta is the one where options in this name have been getting kicked, but as their CapEx hopefully changes going into 2028, maybe the street has a better perspective on them as well. See some people saying they sold some Nebius. I mean, Nebius was a good trade over the past couple of days. If you bought it, 140, 150, 160, getting to sell around that 190, 200 range. Qualcomm, this one fell at about 2.63%. ARM, this was down on the day. Oracle actually had a decent day, closing just below 130, but the stock was at 114 on Wednesday. So, you know, those names also kind of took a bulk of the beating. Speaking of Meta, by the way, this was the big chart. That's the most important thing. Usually Q2 revenue is not higher than the previous Q4 because Q4 is holiday season and that's where all the advertising spend goes. Look at what they did. Q2 was higher than Q4 for monthly revenues per average family daily active person. It was just unbelievable. Like the level of growth that this company, and this is only because of AI. This is only because the targeting on AI is just better and better. There's no earnings today. Today's a Friday, so there tends not to be earnings on Friday. But I mean, you're just seeing the business grow. You're just not seeing the communication of that business start to be as strong as it needs to be. Why did you have Elon and Vlad in your thumbnail? That's a good question. Just pick Elon and Vlad. A lot of times it's just, well, let's pick these two guys. I mean, sometimes it's timely based on what's happening, but other times it's like, well, we'll put Elon and Vlad on there. You guys mentioned that last time I had Lisa Su on there, and there was no AMD news. Why Lisa was like, why not Lisa Su? We put Jensen there all the time. Might as well have Lisa Su there as well. Okay, I think, is that it? Is that most of the updates we have for Friday? Talked about the Leopold thing, talked about Reddit, talked about the Iran stuff. There weren't any crazy things that happened throughout the majority of the day. Obviously, Amazon has been awesome. Didn't see any major headlines. That Elon story with Tesla was fake, according to Elon. Yeah, I think that was... Oh, there was an Ambarella, if anyone's in this. NXP is thinking of buying Ambarella. That's why that stock was up 20%. So that's in the AI edge robotic space. I don't know if Jason's still in this one, but he did like Ambarella. So if anyone was in that one, then that one got a little bit of a move as well. All right, so let's bring someone onto the show and get their take on big tech earnings, Mag 7, CapEx, and this entire Leopold situation. Ladies and gentlemen, Mr. Christopher Patel.
Why are you even calling me Chris Patel? You might as well call me Chris Burry. That's what the chat knows me as at this point. You know,
That's fair. That's fair.
I've started to just sort of accept things as they are. Like, there's always going to be people, like, they just don't want to hear anything that does not just have max bullishness.
Which, by the way, Camilo on the show this morning, I'm so happy he said that. He was like, if you are not studying the bear case, not only of a stock, but of the broader market, if you're bullish on the market and don't want to hear a bear case for the macro, for the market itself, like, what are you doing here, right? You have to have the others. You have to know the bear case better than the bull case to continue to be bullish or bear. Like, you have to hear that perspective. I agree.
Yeah. And one of the realities, though, is like this whole thing that happened to Leopold. I think people forget that your thesis can be right in terms of long-term direction. But if you get the short-term wrong and you're over leveraged at the wrong time, dude, it can cause a serious bit of damage. And not only does it damage you, but it damages the investors who pooled their money with him, and then also the reputation. I think the reputation hit is probably the worst, you know? And I mean, look, every investor goes through these moments. Like, I have never met an investor that didn't have a point where they were, you know, absolutely demolished by something that they never thought could happen, but then it happened. And as you get older, you realize, like, hey, wait a second, you know, like, I need to be a bit more cautious. And that's why if you look at like the older investors, they are a lot more careful than the younger guys. The younger guys, like SBF. I mean, if you look at SBF, had he not played his stupid games, he would probably go down right now as the greatest investor ever. But he got very, very confident in his picks, and they didn't perform that well in a very short period of time. And then he ended up having to do all the other bullshit that he did just to, you know, like, pretend everything was okay. And, you know, it didn't work out well. So I'd say to anyone who's a young person, make sure you have old friends like me and Steve, because we've gone through this shit. I was a youngster making like 300, 400% gains. And then one day shit happened, and literally that bear market came right when I didn't expect it. And like I said, I've taken my fair share of hits. So for me, when I see way too much optimism, like, it's almost like this second nature that just comes around, and it's worked against me too. Don't get me wrong. Like, it's not, oh my God, everything is great. Like, now all of a sudden I'm the best investor on the planet. But no, it's like, it's one of those things that you just develop. It's like scar tissue, you know, it's something that's there, but it's always like that reminder that if you don't do the right thing, you're gonna get hit.
So let's get into the CapEx story, because this is a thesis you've been kind of on, which is that CapEx will slow down. You saw the Amazon earnings, Google, Microsoft, they all increased it. Amazon increased by 20 billion this year. Microsoft, a little bit more rationalizing of not increasing, Amazon going full throttle. Is the CapEx still going to slow down, in your opinion? And if it's not, why are the semis not a better bet here than some of the other sectors?
All right. So the first thing is you have to deeply listen to the calls. And one of the main things that I notice is that there's a big discussion around ROI now, right? Like Microsoft mentioned, I think Satya even said, we're going to create a dashboard so people understand that we're not spending money into a black hole, right?
Yeah.
Jassy, everyone looked at that CapEx. They're like, oh my God, CapEx. But Jassy even said, like, look, right now we see a lot of demand. But if we see that demand is weakening, we are going to cut back. Like that was clear as day in there. So the key right now that we have to focus on is the demand is out there. They're getting these 5-year long contracts. So it sort of makes, the current investment cycle worth it for them. But I'm starting to see a little bit of uncertainty around how some of the main contracts, like counterparties, are going to be able to live up to that like purchase, right? So if you look at all the hyperscalers, you combine them together, half of that capacity, it's OpenAI and Anthropic. And right now, the question is still in the air because we have not seen their S1s yet, how they plan on financing this, their commitments. Because you're looking at almost $1 trillion plus of commitments, while at the same time, you have the onslaught of Chinese models coming out at like prices that are sometimes 10 times lower than what the current like models are for OpenAI and Anthropic. And so there's a lot more optionality that's out there. And so I think the market right now is looking at that whole thing and saying to themselves, until we see that Anthropic and OpenAI can actually live up to those commitments, we don't want to get too far into them. Like we want to give ourselves a little bit of pause. Now, the problem is,
Chris, you can keep talking. Yeah. Just give me one. I just got to replug my charger, so you can keep talking. I'll be back in a second.
Yeah. The problem is the cascading of the downside can happen so quickly that you have to be cautious. Like this is just me saying this is the scenario. OpenAI and Anthropic, they come out, they go, the S1 comes out, and it looks like they have massive losses on the balance sheet. They have cash on the balance sheet, but they have massive losses. And Sam Altman said, we're not even going to break even until like 2031. So you've got a limited source of funding that these guys are going to have. Like no one's going to lend money into a business that's losing money without getting like a lot of interest and like risk that's out there. So you have to be very careful on that part. While the models that OpenAI and Anthropic have right now are God tier, like literally they're at the top of their game, there is no guarantee that they're going to stay up there. The other debate that a lot of people are having also is that, but Chinese models, no one's ever going to use Chinese models. And I'm like, be careful with that theory. But importantly, remember,
even if there's Chinese and American models, the CapEx is still continuing, though. That was my takeaway from the Mag 7.
No. So like I said, the Mag 7 right now, in my opinion, they are talking like the ones that are very, very bullish on this. I have to ask myself what their interest in being overly bullish is and being cautious is. And the thing that gets to me is everything relies on their OpenAI and Anthropic stakes, because those are the things that basically like propel the CapEx without looking too bad. Like no one is going to come out right now and say, well, like we don't know if there's really going to be like, did you expect Amazon, like Jassy, to come out and say, we don't know if Anthropic's going to be able to pay us or OpenAI is going to be able to pay us? Like if they don't say that, then of course, what is the opposite of that? You want them to IPO as high as possible. So you need to basically put out the message that everything is great. OpenAI and Anthropic are killing it. Don't worry about it. I think that's one of those things that I'm asking myself, like, what the hell? Now I'm thinking I'm game theorying this out. And the thing that really irked me was that backstop from NVIDIA. I did not like that one bit.
On what? On the NeoClouds?
No, on OpenAI.
Oh,
like
on
they have
OpenAI.
a like with a $250 billion data center, and NVIDIA said that they would, back the project. Some people took that as confidence in saying, oh, wow, NVIDIA's there. I'm like, look, if you need daddy to come in, that means the cosigner is not in the greatest of financial shapes. Like when OpenAI comes out, I'm sure that they do not want to go to NVIDIA and say, please backstop me. Their logic, if they can go out right now to the banks and to private investors and say, look, this is how much money we're making, please give us money. Everyone would have said, sure, let's go. I'll pay for it. No problem. But whatever it was that they did not like, it's something to keep in mind.
So your take from the call, and I agree with this, Jassy was very explicit, like, if we think demand's going away, we're going to stop the CapEx, which even Camillo talked about. That was the right vocabulary to get the street to be on board with it. But if demand doesn't go away, if the AI workloads continue, even with the Chinese models, which, by the way, there was a report that Kimi used 20,000 NVIDIA GPUs they got from like Thailand or something that came out this morning. So the Chinese models are finding a way to get through the export controls.
Yeah.
If that continues, then the semis still probably have room up, right?
Yeah. Yeah. I think
because the CapEx still is going to go at least for 27.
I think the key here is that this is more of a question around timing. I don't think any of these GPUs are going to be orphaned. There will, in my opinion, there will never be a day where the NVIDIA GPU is like literally like being sold at the bargain store. Like that's not going to happen, But I do think that there has to be this period of dispersion or diffusion that has to occur where people actually end up in a place where you basically the investment makes sense from an ROI standpoint. Now, Jassy, one of the things I really liked what Amazon communicated was that he actually gave like a structural breakdown on the ROI, saying, look, we are going to build out these shells. There's the CapEx is two-part. Like people really need to take, the CapEx numbers and like separate them out a little bit, because if you do that, you'll understand why the hyperscalers might be a generational buy if this thing all blows up. Like if the AI trade blows up and there's like max bearishness and the hyperscalers are the ones that take a brunt of it because of just plain old association, maybe because of like the debt on the balance sheet now that they have and the free cash flow. I mean, the market gets irrational. Like whenever you see like crazy shit happens, things can get sold off very quickly. And a lot of people will sell shit off. I would be the first one to buy as much Amazon as possible if that happened. And do you know why that is?
Why?
Amazon understood that it's not the frontier models that are going to be the real value accretion mechanism. They said it it was amazing that he was very transparent about that part in the transcript. Like if you want to pull up the transcript, he said the future is small open weight models that basically everyone is going to train their own proprietary data on. Like he just plain out came and said it, which I'm not sure that the Anthropic and the AI guys liked hearing that, but doesn't really matter at this point. Satya said the same exact thing, by the way, that the chances of like the proprietary, like closed model business is probably not the one that wins long term. I think everyone realized. Karp said it too. Karp's like, look, you want to allow these, OpenAIs and the Anthropics into your business so they can basically data mine you to death and kill your business. Like, that's not what you want. You want sovereignty. You want to make sure that the data that you have, the proprietary data, is not being trained by OpenAI and then it's being sold to a competitor to make, their shit better. So I do think that I think a lot of businesses, eventually they'll get to the point where they're not just going to be like, oh yeah, let me sign up for a Claude Max subscription, or let me just sign up for the Claude API. It's going to be more like, hey, listen, I'm going to work with a Palantir, and basically Palantir will source the compute and all the other stuff and source the model or help us train our model. And we will actually get a good use case of the AI, but we're not going to be handing over our data that literally we took decades to build, business processes that are decades long, and hand it over to Dario or Sam. you know. So that's where I think we have to just understand.
You do think Amazon should be at 15% though today, right?
Oh yeah, definitely. Like Amazon's greatest secret, in my opinion, right now is Amazon Bedrock. Like Bedrock does not get enough attention right now because that is their growth vector for future growth that no one is giving them enough credit for. Like they're like, we're going to be model agnostic. We're not going to be like, oh, you need to do this. No, you want to bring your models, bring it. We'll provide the infrastructure. We'll charge a margin on it. Totally cool. We don't care about the markup on the model, right? Like Amazon and OpenAI and Anthropic, they give a shit about the markup because that's how they make their money. But the infrastructure is where Amazon shines. And Amazon is one of the best things about Amazon is that they understood that this was going to be a margin game. So what did they do? They had their own custom chips and accelerators. That was another part of the call that I really, really liked, which was that Amazon was saying, look, if you look at the number, like if you look at our customers, all of them are running their EC2 on our Graviton chips, on our CPUs, right? So not only do they have custom training GPUs, which is great, and they even shouted out NVIDIA, but they also have their own custom CPUs that they are much, much better in terms of margin for them. So if they had to buy like Intel or AMD GPUs and have to pay them margin, that means that that's margin that they're not capturing, right? That's one of the challenges that you have with a company like Meta. Even if Meta gets their shit together and says we're going to launch a cloud service, there's a reason why AWS is the most profitable cloud even till this day. Like Google is catching up, but these guys are not like idiots. Like they know how to run the cloud business. They were the first guys. And if you want to look at it, Andy Jassy is the guy who built AWS, So in terms of like infrastructure, you just can't beat Amazon. Amazon's infrastructure is just on another level, especially Jassy understanding the core business. So I went on a tangent, but let me go back to the thing. What I really liked was he was like, let's separate out the two parts of our CapEx. There's the actual build out where the physical body is. And then there's the actual CPUs, GPUs, and servers. The CPUs, servers, and all that stuff, that has a 5 to 6 year depreciation cycle. This has a 25 to 30 year depreciation cycle. So right now, the build out has both of these things hitting at the same exact time. But over time, what you're going to see is the server and chip part end up becoming the main thing. And then this part, because the infrastructure is already built out, is going to go away. The other thing is they even said it, like the infrastructure that we're building out right now is going to be swappable for the next 5 years. So it's not like they're building a data center and then all of a sudden now, like 5 years from now, that data center is worthless, So this is where you might have a little bit of trouble with CoreWeave. And I know a lot of people, you guys love CoreWeave, but let me just be very, very like open with it. The challenge that you're running into with something like CoreWeave is that a lot of their data centers, they were built with H100s in mind, and those are all air cooled, right? The thing is, all the newer stuff, the Vera Rubins, all of that is liquid cooled, and that's a brand new infrastructure project. So I don't know how CoreWeave is going to be able to finance both of those things again with already the debt on the balance sheet. Like I said, I need to do
every project they've enabled has to do with air cooling versus liquid cooling, you're saying, or that's not something they would be able to figure out logistically, given the scope and scale?
I need to look into them more carefully, because I know that when they built out a lot of their stuff, they built it out specifically for NVIDIA's A100 and H100s, which is, cool with air cooling. Air cooling was fine, right? The key is with liquid cooling, you need a lot more other things that happen. It's not a simple swappable. Whereas Amazon is building the future-proof version right now. So it's like in the future, they can just, hey, listen, this GPU cluster has already been sort of, played out. There's more efficient options. Swap it.
Well,
I'm sure that there's going to be more than that. But
NVIDIA is not letting CoreWeave fail. So that's the other thing about it as well. So I want to talk about Microsoft, because that's a big one. Triple V, thank you for the super chat right here. Triple V actually texted me this today. I didn't even know this. I wonder if anyone in the chat knew this. I didn't say this stat yesterday. Microsoft gained $448 billion in market cap yesterday. It was the largest one-day gain ever for a company in history. The previous record was NVIDIA, April 9th, $441 billion. So yesterday was a really big day for Microsoft at 448 billion, largest one-day gate in market cap. They didn't increase CapEx. They will next year, but not for this year. Amazon did. Their stock went up kind of on like chilling out, whereas Amazon went full throttle and their stock went up. So what was the difference between those two calls? And do you think there's better risk reward now in Microsoft over Amazon?
I think Amazon's always been like the risk taker in all of this, because their logic is we don't have a core business that's our growth business. Like, it's AWS is good. It'll probably grow 15-20% per year. But I mean, the ads business is really still good for Amazon. Microsoft can kind of sit on its side. It's not in any existential threat, even though some people say like you could just vibe code Windows. I tell you, good luck with that. They've got like Microsoft just has a really good franchise. So they don't have to worry nearly as much as like Amazon does in terms of like competing against Google and Azure and everything else. So I think Microsoft is taking a little bit of a page out of Apple and saying, look, we're fine with spending money on CapEx, but we're not going to go so crazy on it that it could destroy our balance sheet and then impair us long term. The good thing about that is Satya's a really good capital allocator. So he's looking at the total ROI on this, and he's not necessarily seeing the same level of demand way out into the future that Jassy is. Jassy's seeing that demand is going to continue. I think the reason might be because Amazon is sort of forced to be bullish. I don't want to say that. That's probably the wrong word, but they're sort of forced to be a little bit bullish. Where if they're not as bullish, Amazon doesn't get to sit on its like subscription laurels like Microsoft does. Google is the same thing. Like Google search is being disrupted. Like I don't care what anyone says, to be honest. I'll just be very blunt. Like
You're not seeing that in the numbers, though. You're not seeing that in the numbers.
I've done some homework on this, and what they've done is basically gone a little extra with their advertising, and so they're actually losing. They're still gaining in terms of like the dollar amount, but the pricing that Google is starting to charge is becoming a little bit predatory to make up for that difference. And the thing is, some advertisers are not feeling that. And you can do some research on this.
Where are they going to go?
Huh?
It's Meta or Google. It's Meta and Google. They're not going to go anywhere.
No, I agree. I totally agree. They're not going anywhere. But the problem that you run into is that with search right now, with agentic search and everything else, there's just a lot less of people just going into Google and typing in whatever they want. I'm not saying that people have stopped doing that, but in terms of like future growth on just plain old 10 blue links, I think that is a slow, very, very slow burning business for them. So they have to invest and basically make sure that they can basically replace all of that cash flow with another business segment. And they're doing that by subscriptions. Like if you look at Google, Google's got like subscriptions all over the place now. Premium, TV, what is that called? Gemini, music. So they're engineering their way out of obsolescence, basically. I'm not going to say like Google search is obsolete in 5 years. Like, I'm not saying that. But the thing is, like the past where you could get double-digit returns on just Google search is, I think those days are kind of coming to an end. So
we do have some breaking news right here, folks. New York Times, Kevin Warsh is considering reducing the frequency of Fed policy meetings. Warsh floated the calendar change proposal at this week's FOMC. A revised meeting schedule could be decided before the next September meeting. Reducing the 8 annual meetings would mark a major break from decades of precedent. The headline should be Warsh is considering reducing frequency of attempts for Citadel to manipulate the market. Because that's what these FOMCs, I mean, I kind of don't hate that. Like, the FOMCs are kind of useless if you think about it.
I think Warsh has got a lot more like laissez-faire in terms of like policy, which was very interesting because he's like, listen, if I give forward guidance, the market reacts in a certain way. Why don't I just let the market do its thing? Like if interest rates go up, that controls inflation on its own. And I'm like, yeah, it kind of makes sense. Like right now I'm trying to buy a house, right? I just came back from something and I got to finance a house and the 10 years up. So now I'm like, man, can I really afford this house? So now what happens? Like I spend less, right? What happens to all the people selling their homes right now? They're like, oh, I can't find buyers because the interest rate is 7% almost on a 30-year. So they lower prices on their housing, right? Now, here's the thing. He could be manipulative and be like, I think we're going to do rate cuts in the next 2 years. It's going to be down to 4s. And people, what do? They go out there and they freaking start buying houses because they're like, oh, I'll just refinance in 2 years when interest rates are lower. So let me go buy this house right now, right? So I think his intention is actually good in saying, let the market uncertainty do the job of controlling inflation.
Yeah, what are we supposed to expect out of the FOMC? Him saying we're looking at the data. Like every month, he's not going to have so much data to be able to make some massive proclamation on where inflation is, right? Like it really is just theater. If they did it 4 times a year instead of 8, I don't think that's crazy, or even 6 times.
I mean, look, if like let's say you're a business, if you're a business right now, and he said, look, in 2 years we're going to be down by 100 basis points. Like we're going to forecast a 100 basis point cut. You know what every business would do? Be like, okay, cool. We'll spend the money today. When shit hits the fan, we'll refinance. Now everyone is like, well, maybe we shouldn't be spending all of this money because we don't know what's going to happen in 2 years. Uncertainty in itself is a very powerful tool on getting people to calm down on spending. Like the bond market is putting the screws on the hyperscalers right now, especially Oracle.
Well, why do you think it's spiking the way it's spiking?
What happened?
Week? Why do you think you're spiking?
Uncertainty. Plain and simple,
About
uncertainty.
oil?
No, around everything. You don't know what the Fed is going to do in a year to 2 years. So now what do you do? So people are saying, hey, listen, I need an uncertainty premium because look, all right, think of it as you right now. You're looking at this and saying 4.72. What if inflation is, I don't know, 7% in 2 years? You're going to ask yourself, wait a second, I don't want a 4.72. I want a 5. And so naturally that 10-year treasury goes up, right? And when the data comes out and says, oh, inflation is fine, what's going to happen to that 10-year? It'll come down naturally. But the thing is, like, by the Fed coming out and being like, oh my God, we think this is going to happen and we think that's going to happen. And then people make their decisions based on that bullshit. And then the shit doesn't work. And then people get angry. And so sometimes what it is just too much market manipulation with the Fed. And so I think Warsh is just like, look, Jerome Powell came out and said to everyone, oh, this is transitory. What did everyone do? They went out there and spent crazy amount of money, right?
True. Yeah.
Had Warsh not said anything, not Warsh, had Powell not come out and said anything and just said, hey, listen, inflation's going up. We'll take policy actions and take, and raise rates as the data comes along. People would have not naturally stopped the spending and actually like been like, oh, wait a second, maybe I shouldn't like go out there and spend all this extra capital that, that basically juices the inflation even longer. So like I said, I think we are in this position where the Fed is, I'm almost 100% sure the president is not liking this. Like Trump is probably pissed the hell off. Trump wants cuts, but I'm sure Warsh probably went to him and said, look, Mr. President, if we want inflation to come down, we need to let the free market do its job. And if you think about it, Warsh is a Republican, and Republicans are traditionally free marketers. So he's more of a traditional Republican. So I think that's what we're seeing today.
This stat is true. I mean, 2018 midterm year, 10-year at this levels, market took a hit towards the end of the year pretty badly. I mean, April 2025, market dropped 30%. Like, it's actually surprising to me S&P is near all-time highs with the 10-year spiking like this. But I also think the market knows that if Trump stops the Iran thing, oil comes down, 10-year comes down, stocks theoretically aren't that expensive.
It's uncertainty, man. It's a lot of uncertainty.
Right.
I mean, I think the reason why the market is up right now and why the market was down is because we're getting a slow cooked upward move versus when the 2018 happened, you had the Fed raising rates. And so you didn't know when it was gonna stop. Right. So a lot of people, they said, wait a second, I better take some equity out and, chill out. You also have this AI CapEx super cycle. So there's a lot of liquidity in the system, but if we do have any sort of recession that comes along, primarily because when interest rates start going up, people figure out who's dancing in the rain naked, you know?
Yeah.
Like when interest rates started to climb up, we found the SVBs out, right? And we found the First Republics out. And we saw that their AOCI losses were absolute garbage. And then basically you had this clearing event, and then everyone got scared and the market dipped, you know? I think that's the same thing that's probably going to happen now, where there are businesses that are very profitable at 3% rates. They're okay profitable at 5% rates. At 7% rates, their business does not work. And that naturally means that they would have to cut back on their expansion plans, on their CapEx and all the other stuff. So I don't know if we're going to get a black swan kind of event that causes a 2018 kind of thing where, you know, you have one credit event happen and all of a sudden now everyone's freaking out and panicking. I mean, look, we had that last month. Memory is still down from all-time highs. You know, so
Are you buying the meta dip at all?
No, I have a pretty big position in it already, so I don't want to add any
So
more.
do you think the dip was rational, or do you think this one is a bit silly?
I think it was rational. You know, it's Meta's a little bit all over the place with their AI strategy. So until they come up with some coherent like strategy that people can get behind, I don't know. Like they did come out with that thing with Muse Spark, and they saw that, you know what, maybe Meta is not at the back of the pack. Like some of the investments that they're making actually does have some ROI in the future. I mean, the core business is doing fine. I mean, they didn't necessarily have the best quarter last quarter. If you look at like a lot of their ad revenue spend is kind of down.
Yeah.
Right. So that probably doesn't like do. It's not like, but once again, it's not like they're not doing well. It's just, it's not like the greatest story on the planet. And the thing is, like, Meta's got like a floor right now because the multiple is so low, but there's also like the expectation that you kind of need a lot more like future growth to make it worth it. And remember, you're also competing now against the 10-year treasury, the 30-year treasury, the other companies which are like growing at a much, much faster pace. And remember, Meta is not a small company. It's a $1.5 trillion market cap, you know, so yeah.
If you okay, so Burry shorted more Nvidia, more QQQ, more Micron yesterday, more semis. You think it's the right move to short it on that bounce we had yesterday?
I think his logic is there is going to be a lot of pain that comes our way from the OpenAI and Anthropic IPO blow up. I think that's what he's predicting right now. So he's looking at this and saying there is no way that all of the capital that's been committed to this build out makes sense because OpenAI and Anthropic might not be able to live up to those contracts. And if the market judges that to be true, then what they're going to say is, well, that means that the hyperscalers are going to cut back on CapEx. And if they cut back on CapEx, who are they not buying? They're not buying NVIDIA GPUs. They're not buying memory. Or they just slow down the amount of GPUs that they're buying. They slow down the amount of memory. I mean, memory in itself, if they start like indicating that they're slowing spend, the memory guys are going to get hit the worst because most of the memory benefit that they have has primarily been the premiums that these hyperscalers are willing to pay for HBM and DRAM. So if that gets cleared up, I think memory could take a big dip.
But again, that more broadly assumes OpenAI and Anthropic blow up. I mean, do you think that's a reasonable thing that on IPO with SpaceX a little bit of a different situation? I think. Do you think OpenAI and Anthropic just completely collapse the IPO because their margins get hit from the open source model? Which, by the way, the open source models will still have to use Google, Microsoft, Amazon to run their cloud, right?
Yeah.
So they will still have to buy.
But remember, 30% equity hit is not a good one. Like right
now. That's a good point. That's a good point. That's fair.
If OpenAI and Anthropic go down, now you got to take net losses. Everything that you just recognized as a gain, you got to take that and put that in the loss category now, right? Because now you got operating income, phantom operating and non-operating income, phantom non-operating income that now just turns into phantom non-operating losses. On equity losses.
So. Yeah, Google's not up 94 billion on SpaceX anymore. It's like I think 70 billion or something.
Yeah, so you got to be careful with how you layer this. So I think a lot of the current market is very, very dependent on OpenAI and Anthropic's IPO being a success. If OpenAI and Anthropic's success is not there, that tanks this whole thing.
What if we let them stay private for the next few years?
Once again, I don't know if the market is going to allow that. The reason why the market might not allow that is because these guys, if they're burning that much capital to basically stay alive, they're going to need to raise money from somewhere. They've already exhausted the private inside. So the private investors are like, we're not giving you more money, or at least not at the value that you want, right?
Mm.
Same thing with the banks. The banks are not lending them money. You know how you can tell the banks are not lending them money?
The CDSs on the hyperscalers. Yeah.
Yes, exactly. And on top of it, they had to get Jensen to back them. If you went to the first thing is you try to get a loan for 250 billion by Anthropic, OpenAI, whatever, to say, look, we can build, we want to do this build out. You need to give us this money so we do this build out. The first thing any bank is going to say, give us your financials. Right? Like, I'm not going to lend you money if you're not giving me financials. And you know what every single one of those banks said? Oh, hell no. Fuck you. We're not doing it. You're too risky. And then they had to bring Jensen in. And Jensen, hey, guys, listen, I know that I can't afford this, Hellcat, but my daddy Jensen says I can, so it's okay. And so the bank's like, well, if NVIDIA's backing you, sure, we'll give you some money,
Do you think the July momentum downturn was majority this forced deleveraging because of Leopold and funds like him? Or do you think there's something deeper going on that the market is upset with?
I think there's just a lot of risk in this market. So any like even small hiccup can really like put the fear of God into people. So I think the market is very skittish right now. Like you just need a small bit of like investors are like, I would say you have to be careful because right now the market is driven more on psychology than just pure numbers. And so market psychology, as you get higher and higher up, it becomes harder and harder to ignore things. And so what happens is if you get to a certain point where, like you're at all-time highs, like you're trading at crazy high, like expectations, all you need is one little expectation to not be there. And automatically everyone's like, oh my God, like everyone wakes up out of this like mass hallucination and said, oh my God, this shit is actually a dream. Like, that dream turns into a fucking nightmare.
That's what happened in July. That's legit what happened in July.
Yeah, I mean, just one new piece of news. Micron misses earnings by $2 million. Oh, Micron is dead. Sell Micron. It's just how it is. Now, the thing that you have to remember is that confidence is one of those things that takes a really long time to build, but it's also something that can get destroyed overnight. And so the market has to believe that the memory names can sustain this build out indefinitely to make sure that they're paying a multiple that they're asking. And if the market does not judge that to be true, the market's going to say, I don't care. I don't care about, I'm going to buy back this many shares. That puts a floor on the stock price, but it doesn't put a floor on the valuation.
I'm happy you said that because a lot of these people that are giga bullish memory are like, well, Micron will just buy back the stock. And I'm like, hold on, bro. You can buy Apple at a premium for buybacks because it's Apple and there's a sustainable business with 2 billion users. You're going to buy Micron just because they're buying stock?
Yeah.
They don't know what to do with the cash. They're just reducing the shares in the value. You think that's a reasonable expectation for why you should pay a premium? Like, no. Like if the market's like your demand's not there, you don't know what to do with the cash, you're buying back the stock, you're not actually growing the business at the level you were going at, that premium compresses pretty quickly. And for NVIDIA, it's obviously different because it's NVIDIA. But I agree to your point. Like, the market's not going to care about NVIDIA buying back stock if, the broader CapEx ecosystem is in question.
I mean, the challenge that Micron also has to run into, not just Micron, but SanDisk. I think SanDisk is way more exposed because while Micron can rely a little bit on their HBM and, DRAM also, NAND flash is not like the most complicated thing on the planet. It's like there's no like cartel there. Right.
Yeah.
So I think you have to be same thing with like Western Digital with like, their tech. So any sort of indication that the Chinese are coming too, I mean, you have to take that threat seriously. Like the Chinese are, in my opinion, a real threat. Now, people will say, well, the U.S. government would just never allow Chinese things to come into America for national safety. And I'm like, you realize that every single person in the U.S. has an iPhone right now that was basically assembled in China? Almost half the components that are in that thing are Chinese. So don't think that you're completely immune. And even if, let's say, you did think that's the case, let's say that scenario plays out. Right now, SK Hynix, Samsung, and Micron, 30% of their revenues come from China. The Chinese would just say, okay, you don't want us allowed into your market, screw it. We will just replace you in our markets, and now you got a 30% hit. Where are you going to go? Where are you going to sell your shit to?
That's fair, but I don't think it would be easy for the CCP to do that because they don't have enough domestic supply to replace it. And they don't want their inflation up.
Yet. The one thing you never, never, ever discount is the ability of the Chinese to outproduce you on anything. And these guys, unlike the US where we have like processes and all this in place that slow us down, if Xi Jinping comes out and says we need to be the number one memory manufacturer on the planet, I guarantee you within 2 years, maybe even 3, that's exactly what will happen. Like, yeah, some people say, well, technology. I'm like, the Chinese are really good at getting their hands on the technology to get shit done. And they got a lot of smart people over there. So don't think for 1 minute that there is no Chinese memory threat. Like, keep that in the back of your head, that is a real possibility. And I think over time, the news headlines of, Chinese market share from 10% to 20%, that in itself is enough of a psychological hit that could throw memory into like a bear market. So
it's been an exciting month, folks. It's been an exciting freaking month. Chris, are there any names right now that are really catching your attention? Or
SaaS, baby. You're just being SaaS, man. SaaS is where you want to be.
So ServiceNow, Adobe, those are still your big names.
Intuit. Yeah, SaaS.
You like Intuit now?
I like Intuit, yeah.
Intuit, huh? This thing got this. I mean, if there was any time to take a shot on this, 50% down is crazy, bro.
Yeah, I don't think people really understand the business that these guys have and just how big of a moat in terms of like a user base they have and how much cash.
Oh, but hold on, Chris. Before we get into it, we got a headline. Of course, they're gonna do it Friday after hours. Why not? Why not?
Are we bombing something?
U.S. Israel preparing to bombard energy-related targets in Iran, as per CBS.
Great.
Oil is now after hours. Wow, 3% up, 85.75.
Yeah, man. I think this is a sort of a weird thing where the Iranians have a strategy that I think it's working really, really well right now. The logic, I think, with the Iranians is we want to weaken Trump. Like, we don't want to deal with Trump post midterms. So they understand that in order to basically win this war, quote unquote win, they need to keep this thing going and keep oil prices as high as possible and basically wreck the US economy so that this way, come November, when midterms come around, Trump loses as badly as possible. And especially if he loses, he's definitely going to lose the House at this point. Like, I don't think there's a chance at that not happening. But I think if he also loses the Senate because the economy is not doing well and, he gets there's some flips that happen, you're going to see like impeachment 2.0. Not 2.0, sorry. I think it's, how many times has he been impeached now? 3? Or is it 2? Or is it 4? I lost track.
I thought it was once with the Ukraine thing. It was once, right?
Nah, he got impeached multiple times. No, the first time was when I think like the whole thing came out with him like
2 times. It was 2019 and then 2021. Oh, the capital stuff. Yeah.
Right. So this one would be number 3 that he would be coming. So this would be the 3rd time he would get impeached again. So I think that's another challenge that you would run into. So I think the Iranians, what they're doing is they're like negotiating peace, and then once the U.S. is like, okay, we chilling, they do some shit, and it basically drags the U.S. back in, and now the U.S. is like in a position where they have to kind of like keep doing this back and forth dance, and yeah. I don't know if we're gonna get any sort of resolution on this thing until after the midterms now.
If I put a gun to your head and said, Chris, does 2026 end up like 2022? Would you say yes or no?
You mean 2027?
No. 2022 midterm years, slow stair step decline. You get some peaks and those get rejected. You go lower. Do you think 2026 ends up like 2022?
I mean, the credit markets, if something breaks, then we got big problems. You know, I mean, if we see the 10-year at 5%, which is a real possibility, like, don't get me wrong, like I don't want that to happen.
Far away. It's not that far away.
Yeah, like I would have thought like 4.5 was that hard line in the, you know, in the sand to say, look, this was like that red line. But Trump is like, I don't know what's going on in Trump's brain at the same time, because now he's also talking about tariffs again. You know, it's like, you know, that like we've already got this high inflation, and then at the same time you're talking about tariffs. Like, what's going on here? So,
yeah, dude, how do risk on assets logically, forget the capex, forget the earnings, how, you know, Bitcoin included, how do they go up with this type of uncertainty, this type of oil price increases every other day, this type of 10-year credit market activity? Like, how do people feel comfortable paying a premium for risk on assets? You're paying for the growth, and the growth might still be there, but if the macro environment's not there, the growth gets discounted. Like,
we have to look at retail purchase. We have to look at retail participation. You're thinking,
but retail, you saw the stat, right? Retail's losing all their juice, like 623 million. Yeah, dude, I don't know if you saw this. $623 million, more than $500 million, was sold between Monday and Wednesday from retail.
Ooh.
It's the fastest selling case of it. Like, I think retail's fed up with this shit because they buy the dip, and then like the dip goes down another 30%. They're like, oh, like, what? How is the 30%? How is the first 30% not the dip? You know?
Yeah. I don't know, man. I think we could see a slow crawl down. It could happen. You know, especially if the semiconductor names, which have been the high flyers all year, if people are taking profits, that could be a problem. U.S.-Israel discuss trying to conclude before market open. What?
That's a real headline.
Is it really?
Yeah, they always try to get it over with before futures open. So, that's probably true. They're going to try to be done with this before it's over.
Listen, I think me and you need to come up with some cash and buy the Truth Social API, aka Insider Trading API, if that's what he wants to call it. Because I want to know, bro, I want to be on the fly on the wall and listen to his conversation with Bibi. You know, Netanyahu's like in the office. I wonder if it's like a grilling, or if it's just like, hey, listen, what are we gonna do here? You know, like, you think Trump, like, he comes in, listen, I need you to cut it out, otherwise I'm gonna lose this election, and then you're gonna be screwed because I'm your only friend. And that's what he said in the past. Like, I'm Israel's only friend. So, and the one thing that I know people are gonna hate when I say this, but the one thing that I'm starting to see is the political winds are shifting against Israel right now.
That's happening. The American mainstream opinion of Israel is down the gutter. Horrible.
Yeah, and if you go back 5 years, AIPAC wasn't even like remotely a problem in terms of like the voting situation. But now, any House member, any senator that says, "Okay, I'm backed by AIPAC," or "I took AIPAC money," bro, that is like a huge black mark on their like reputation. So I think the influence that AIPAC had prior to this invasion is starting to kind of slowly dissipate. And I think that is something that we have to keep an eye on as well, only because I think that in itself is Israel's like kind of situation where they don't want to like overplay their hand in trying to get the U.S. to be as involved in the Middle East as possible. I think Israel is going to do what they do with their, with their long-term security and safety. That's not going to change. But I think that there is a certain level of what is it called? Conflict that they're not going to be able to go into. Like, I don't think that they're going to be able to do kind of like what we saw early in this situation where you had like targeted strikes for like months on end. Like, I don't think that that's possible. So I think right now Israel will say to the president, like, look, we can do some really quick surgical strikes where it matters, and then we can back off. And I think Trump probably negotiated that and saying, look, I need you guys to calm down. What do you guys need from me to basically give you that security that you guys will not escalate this further? And I think the Israelis are going to say, look, Mr. President, we have these targets. These are our main focus right now. If we get these out of the way, then we'll back off. And I think that's where like this negotiation is happening in the background right now.
I think that's fair. And I think, to your point, I don't know if they're going to go that hard because they also understand the pushback they would get, but they also realize they need to go hard to get Iran to cooperate because, we had a 4-day pseudo ceasefire and then Iran hit the military base in Jordan out of nowhere.
Yeah.
It seemed like there wasn't really something they were, and that is where I think you're right that they want the chaos and the instability.
Yeah.
And August tends to kind of not be the best month, so we have to deal with it. By the way, speaking of August, look at this. July for 12 years has been green. We inched out a 0.03% month for July. Momentum was obviously down a lot. August on average, historically, is down negative 0.13%. Now, the last 2 years were green because we had yen carry trade in 2024, had a massive V-shape after that. 2025, we had the V-shape from the tariff momentum. But usually August is not good. So if we have bad geopolitical stuff in August and then, whatever AI news comes out that makes the market question some of the trade, I think we just got to get through August.
So what's funny is there will still always be people. Someone's like, can we talk about stocks? I'm like, look, if you're not talking about like the macro impact of all this stuff happening, unfortunately, I wish you could be completely blind and say the market never looks at anything, but you're clearly seeing the 10-year rise. And one of the reasons why it's rising is oil prices are higher and inflation is going to bleed in. So if you're doing your stock analysis and you're saying to yourself, okay, this business right now is borrowing X amount of dollars at X amount of interest, how are they going to make a profit? Are they going to miss next year? You have to do that. You have to layer on some macro. The other thing is all of a sudden, if the market starts coming down because people are, worried that this conflict can get broader, and you have a general market sell-off, what do you do then? We have to keep our eye on the macro. I mean, the geopolitics of it, no matter what we do. And I think right now, I think you're right, Amit, to say that we are at a higher risk level than people think, because you've got one side, you've got the bond market that's, throwing up red flags in terms of like interest rates going higher, but then you've got equity valuations that are at all-time highs.
Right.
So, and this is not like I agree with Iran or I agree with Israel or I hate Israel and I hate Iran. Like, it's not that at all. You just have to be, you have to take a step back and try to rationalize, okay, like what is the interest of this party? What is the interest of this party? How does that play out? And based on how it plays out, how are you going to invest your money?
Yeah, you have to look at the macro. You have to. And that will require some level of political analysis. But I mean, this whole Leopold thing, right? If you only focused on AI, you got hit because you're focusing on AI, but you're not focusing on the macro. I mean, I don't know how much Leopold cares about geopolitics and the 10-year treasury. Now, he's a genius at understanding AI infrastructure, but that shit matters when you're operating at that scale. And so, without that understanding, it can lead to tough situations.
Yeah. What do you think made Leopold go so hard on leverage?
I've been trying to analyze this for the past 24 hours. By the way, I've never eaten at Room 40, so I don't know what restaurant that is, but I've never eaten there. I think yes, the greed is there, 100%. I agree with everyone, but like, I mean, dude, he was up 2,000% on his positions, and if you read his situational awareness essay, Everyone should read it. Just type in situational awareness essay and the PDF will pop up. He believes AGI is like 0 to 1,000,000, not 0 to 100, not 0 to 1,000, not 0 to 100, that's 0 to 1,000,000 in terms of what is needed to achieve the singularity. And for him, I think he saw Bloom go from 300 to like 210, and he was like, okay, whatever. Bloom's going to be a, $900 stock in a couple of years. So to him, he's like, whatever. But the weird part about it is like, did you know this guy graduated Columbia at 19, which means he started college at 15. College. He was a valedictorian of Columbia. So you would think someone with that level of analytical rigor would be able to realize, like, I'm a little over levered here before you get over levered, or in the middle of being over levered before it gets as bad as it did where you have to get rid of the fund. And somehow that escaped him. So I don't know the answer to the question, but I think he just felt so deeply about the AGI conviction that he didn't realize the stock market doesn't always care about your thesis.
Yeah, and also you have to remember we're a democracy, so the other side gets a lot of say in things that are happening. Like, let's say right now you get a president who's super socialist. Let's just say it happens. All of a sudden now we need to put a data center moratorium like they did in New York City. Like, not New York City, New York State. Like, what happened to your equation there? Where all of a sudden now the entire country is turning on data centers. And now to get a data center built, you have to go through like all these crazy, like environmental reviews. Now all of a sudden, oh my God, everyone's going to buy chips forever. That theory just goes out the door.
Yep.
Right. So why didn't he take that into account? And I think this is one of those things. It's like, you can try to be as analytical as you want. Yeah, exactly. Dude, Isaac Newton, smartest man, the guy had literally, I think the part that's ironic is that the theory of relativity, like, he discovered gravity. So it's like, oh, what goes up must come down. Motherfucker's like, it's like you should have applied that fucking physics theory when you were buying some stocks.
No, it only goes up. This one only goes up.
Yeah. It's like, bro, Apple freaking knocked you on the head. That should have been your clue. Like, wait a second.
If it happened to the guy who created gravity, it could happen to all of us.
I mean, you know what the best part is, though? Like, the guys like Ken Griffin, they're looking at this and they're just like, keep going, bro. Keep going. Get yourself into this trouble because I'm going to be there to pick up the pieces. Yeah. Like, these market, like, another like vulture in this market is JP Morgan. JP Morgan is always about that. Hey, listen, you want to borrow money? Go ahead. Keep borrowing money. Get levered up. And then when all this shit hits the fan, JP Morgan comes in and says, no, don't worry, baby. I got your back. I'll take all your assets at 50 cents on the dollar. It
must have been fun for Griffin. I mean, I equated to when I was a senior in debate and I had to go up against a freshman. I'd walk into the room. I'd realize they were a freshman. I realized this was their first debate tournament. And I was like, oh my goodness, like, I'm going to feel bad for how bad this is going to go. Because I was that freshman going up against a senior 4 years before. And like, you have to get up and do a speech and you're like, you have no idea what the other person just said. And they just demolished you. And you just like, you stutter. And I imagine Ken Griffin was like, this person has no choice but to give me the best discount I could possibly get. I'm one of 3 people that are even willing to buy his assets. And I control the market maker that literally can continue pushing that to make them cry uncle to the point where he could send Nebius down to 100 if he wanted to. And this guy owns 5% of the company. And I think for him, it was just like taking candy from a baby and proving to everyone that I am the guy when people are in trouble. And there will be many more moments of trouble because human nature, people will get levered up again in the future. And Ken Griffin will be there.
You want to know something? I have a theory. I'm not sure it's true, but it's just a hypothetical. I've been thinking about it. I think Google, I think Microsoft, I think Amazon, all of these guys are going to let these neoclouds build all this shit out. And then when the shit hits the fan, they're going to buy all of this shit up at super cheap on the dollar.
You think the neoclouds are building what up?
I think, like Google's like, oh yeah, we're going to backstop you and we'll do this and we'll do that. And Applied Digital will back you, right? And
even the wolf and the ciphers, all that stuff. Okay.
Right. So basically saying, oh, we'll back you. Don't worry. And the thing is, the way that Google is structuring these things, it's like, it's almost like the equity holders are going to basically pay for this data center build out. Shit hits the fan, and then Google buys everything that those equity holders lost.
Yeah.
Like, okay, like look, CoreWeave, they take on a lot of debt. They have all this equity. They're using that equity to finance the construction. If this shit blows up, you don't think Google's going to be out there? Yeah, I'll buy your data center from you. I'll buy your capacity at 50 cents on the dollar. You don't think Amazon is going to do the same shit? Well, they have the liquidity. They've got the capital. But if you can get it at 50 cents on the dollar, shit, I'll take it. So go ahead, keep building your shit out, Nebius. Keep building your shit out, CoreWeave. Keep building your shit out. But the day you can't pay your bills, I'll be there to pick up the pieces.
It's a fair bear case, dude, because I think no one can deny that shit can blow up. We literally saw it this month. If it blows up even more, I mean, the neoclouds are levered up pretty heavy. And I know NVIDIA is trying to backstop them, but at some point, if it really hits the fan, how much of the backstop can NVIDIA even provide? Or if anything, does NVIDIA just buy them out for pennies on the dollar? It's a valid bear case if things actually blow up.
I mean, look, it's predatory, but that's just how the world works. I mean, I saw the same exact thing happen with like oil in 2015, 16. All the wildcatters, they were out there drilling holes everywhere, buying up land, buying up leases, and they were using equity investments and debt.
Can you tell people the story about your oil run in 2016
without it giving me PTSD?
Yeah, people need to hear this, dude. In the month of July, people need to hear this.
So this was 2015, 2016. I had gotten too cocky with a lot of distressed debt investing. Like I had made a lot of money. And one of the things that you can do is you can buy unsecured bonds on certain companies. And so oil had taken a nasty dip. And I was looking at some unsecured bonds that were trading at like literally 10 cents on the dollar.
Why oil taking such a big dip around that time?
What is it called? The Middle East. They were just pumping. They were like, look, we're going to declare war on oil prices. And so they increased production like crazy. So oil went from like $100 to like 50. And the unit economics on a lot of those wells only make sense from a capital investment standpoint. The break even was like $75, $80 a barrel. So what happens is at $50 a barrel, this thing is unprofitable, right? Because you already have this sunk cost. You have all the drilling that you did. You had all the, personnel. You had all the geological mapping. You had already paid all the leases. So it was like a sunk cost for them. What happened was a lot of that unsecured debt, the assets were real. They had real value there. And that's what I was banking on, because if oil prices came up, the bonds would end up spiking. And so what happened was a lot of people came in, did the same thing that I did, is they bought a lot of that debt, pennies on the dollar, and they went to the company and said, look, we will, and I'm pretty sure that like the board was corrupt as shit, but basically they took all of that bond, they took all of those bonds, and they basically said, look, we will forgive half of the debt, but you give us another piece of debt that gives us super priority over your over the already existing debt holders. So imagine right now, and I'm going to try to break this down. Imagine you basically have $1,000 of debt, right? That debt on the open market is trading at 10 cents on the dollar. Okay. So like Chris Patel comes in and says, I'm going to buy some, but I'm a small fish. I'm not like a big fish. Someone comes out and says, listen, I'm going to buy all this, as much debt as I can for $10, $10. Remember, the notional value on this thing is literally like 1,000. They come in and go buy up all of this debt for 10 cents. They go to the company and say, hey, listen, I will sell, I will basically forgive half of that debt, but you need to basically issue me new debt, and the new debt has super priority. So, and the value of that new debt is going to be, let's say it's going to be, $500. So you're basically erasing $500 of actual notional value of debt. Like let's say I bought mine at 100. So basically
Yeah.
they were able to 5x their money and they got a secured claim.
Right.
Company goes into bankruptcy. All of a sudden now all the assets, it gets put into their bucket. And so they make out with 100% return, right? Technically they made almost 500% return because they were able to buy unsecured debt cheaply and then transition that to secured debt. And all the unsecured debt holders get wiped out.
So what happened to you and your unsecured debt? Because Chris bought so much that he was in the SEC filings of this shit, and you were up on it. But
yeah. So when these guys made the offer, everyone started like all the unsecured bonds. They were like climbing, right? Because if you have a company that owes 1,000, now all of a sudden they only owe 500. That means that all of that shit technically the debt became easier for the company to finance, right? So the bonds all went from 10 cents to like 30 cents. Me being a greedy piece of shit, I didn't get out. I was like, bro, I'm going for that 100, And what happened? Oil never recovered. Bonds ended up going to fucking zero. Like the unsecured bonds ended up going to zero, and that's all there is.
You're basically up 3 to 5x on your money. You wanted to be up 10x on your money, and you just didn't get out. And this was heavy six figures. This wasn't a small amount.
Yeah. Good times. But it is what it
is.
is.
The point is greed gets to everybody. That's the point. Greed gets to everybody.
Yeah, I made a lot of money on other bonds. Like there was some distressed debt that you could have bought in 2008, 2009, like Ford Motor Company. Their bonds were trading at like 10, 20 cents on the dollar. And literally all you had to do was just hold it. And this thing would have went to 100. And a lot of times that's what happens. As long as a business is real, it's got some turnaround strategies in place, you can do really well. And sometimes you don't even need the bond to recover to 100%. Your return comes from, like, let's say Ford issued a bond, like an 8% bond when things were good. $100, each bond is worth 100. Every year they give you $8 of, return for that. They give you interest. And then some shit happens to the business, and now those bonds go down to like 25 cents. Well, guess what? The yield that you get on that, because it's now only worth 25 cents on the dollars, you're not getting 8%. You're getting 8 times 4. So you're getting a 24% return on your cost basis. So let's say Ford, those bonds stay at that 25 for like 4 years. You already got your money back. And then if the bond, let's say if the business improves, that bond goes from $25 to now, 100, and now you made 4x the money. So some people will say bond investing is for old people. And I'm like, you want to look at some bonds right now for like Oracle? I'll show you all interesting thing.
Real quick, do you know Ferguson Enterprises?
I don't.
They just joined the S&P. This is a HVAC plumbing company.
That's awesome.
So there you go, up 7%. I don't know if people know about it, but
the only Ferguson I know is Massey Ferguson. Do you know who Massey Ferguson is?
of course I know who Massey Ferguson is.
You're Googling it right now, aren't you?
No.
Bro, you're from the Penda. I can't believe you don't know Massey Ferguson. They're the tractor maker, Massey Ferguson. In India, they're popular, super. Like in India, if you go to India, if you own a farm, you'll see everyone is like obsessed with Massey Ferguson.
I thought it was an actor in a movie or something.
Is it really?
Okay. Are you
Okay,
okay? Oracle, yeah.
So these are the different bonds that are out there right now for the like some of the hyperscalers out there. So you have Oracle bonds right now. This is a 6.1 Oracle bond trading right now at 78 cents on the dollar. Okay, which means you're going to get a 6.1% yield per year. But because you're buying it at a discount, your actual effective yield is about 7.8.
Right.
Okay. So the key
But
here is
what is the risk to that yield?
the risk to this yield is that this thing goes to zero.
You mean Oracle goes to zero or the bond?
Oracle goes to, well, the bond goes to zero because Oracle goes into bankruptcy. But remember, you're sitting you're sitting behind $300 billion of equity before anything happens to Oracle.
Right.
You know,
Hold on.
So
So Oracle stock could go to $1 next year, and you would still get your yield. Is that correct?
yeah, you would still get it as long as the company doesn't go belly up.
Wait. So that's very interesting. So you could guarantee yourself 7.18% effectively. Let's say you have like $10 million. You can guarantee yourself
7.8%. 7.8%. You can lock it in right now, and you get paid 7.8% for the next. What is this? The maturity is 2065. So you can get that until out of 30 years if you believe that Oracle is going to last 30 years. Now, the benefit here is also if, let's say, Oracle improves their financials, you know, this thing rides back up to what it was before. So if you look here, when that bond was issued, it was issued at 93 cents on the dollar. Now it's trading at 77 cents on the dollar, right?
So you could sell it at 93 cents if like sentiment changes and Oracle does well, effectively.
Yeah. Or you could just let it keep paying you money. You
Right.
know? The other benefit is that let's say you do get rate cuts, that means that Oracle in the future is going to be able to finance their debt at a cheaper price. The bond right here would end up climbing up back to like 93s again. I mean, you could see that with like certain issuances, like Amazon right now, their $3.25 what is it called? 3.25% yield is right now trading at 50 cents on the dollar. Look at this at $56. That's there. If let's say interest rates were to get cut, right? This thing would probably spike up to like somewhere in the hundreds again, but you would need like cuts to be so drastic that it doesn't make necessarily a lot of sense to buy it. Because I mean, you're literally getting only a 3.25% yield. So you kind of need like some yield to make sure you're getting something. So like right now, if you look at the effective yield on this, it's like 6.3%. If you can get from a 30-year treasury, like 5.2% right now?
Yeah.
Then you wouldn't necessarily, why would you want to take the risk on Amazon? The risk-free rate is there. But here's the thing. If, let's say, recession comes, right? And all of a sudden interest rates go down, like the 30-year goes down, plenty of people are willing to jump into this. Like a lot of bond funds will come in and buy this up.
But so Oracle, 30 years, 8%. Do you have to hold it for 30 years to get the 8% every year?
I mean, no. You just
like could you hold it for 1 year, get the 8%, and then if it jumps to 93 cents, sell it the next year?
You can sell it anytime you want. The only thing is you get two parts. You get something called accrued interest because, like, let's say you bought it in January, they pay twice a year. So if you want to show this thing, you can show it real quick. So right here, they pay semi-annually, right? So they pay you basically twice a year. So they don't give you 8% every year. What they do is they give you 4% and 4%, not 8%. Sorry, it's a 6.1% bond. So you get 3% on the notional for what it was, right? So right now it's trading at a discount at 78, which means that you're going to get paid, whatever your cost basis is. They're going to base their cost base on that $100 when they issued it. Mm-hmm. So basically you would be collecting 3% and 3%, but technically because you're buying it at a discount, you're probably looking at closer to like 3.8, 3.9%. And the thing is, it's so far out in terms of yield. There's not really a lot of like money that you get in terms of like cap, like what is it called? Yield to maturity. Cause that's another thing you have to like understand also. But yeah, I mean, you don't have to hold this thing forever. Like you could sell it anytime you want. Like I could buy this right now and I see that interest rates, are coming down and, Oracle is doing well. I can sell this position. Like if you look at this, there's plenty of time.
That would be like a 20 to 25% move if it just gets back to where it was a few months ago.
Yeah. And you're getting paid the entire time.
Now the risk is Oracle goes bankrupt.
Belly up. Yeah. So this is the key right here. So you can see here, this bond was trading last November at 92 cents on the dollar, right? So,
dude, this is interesting. We gotta get into bonds, baby. That's why my name is James. Know what I'm talking about? I'm gonna become a private credit investor soon.
I mean, look, bonds are.
I would imagine the liquidity in stocks though is easier. or you think those bonds?
Yes. It depends on the issuer. Some bonds are very, very liquid and some are not as liquid. I would say, yeah, you have to be very careful with like the issuer. Like some issuers, they just have a lot of debt on the balance sheet, like all over the place. And you just weigh your thing against that. I mean, if you want to share my screen, like this is how you would find bonds. So Webull actually has a pretty good screener. Let's see, screener right here. So this is the bond screener for Webull. So depending on how you want to do it. So if you want to, let's say, do corporate debt, right? And your issuer, you want it to be like a pretty secure issuer. What you can do is just keep it to investment grade. So right here, investment grade is anything that's AAA, which is like super secure. You don't got to worry. It's very highly rated. And then you got BBB minus. So right now, if you look at BBB minus, these are all the issuers. And these are the different yield to maturities that's out there. So the highest yield to maturity right now is a Mexican oil company called Pemex, right? Then you've got Bright House Financial. Don't really know what they do, but you've got Charter Communications, which is that cable company that has a lot of free cash flow. And you're getting 7.8 for that. So Oracle is up here as well.
The reason these hyperscalers are levering up so heavily on debt, and the reason the bond market is willing to pay it, is because basically they think the Max 7 aren't going out of business anytime soon. And if they can get 300 basis points above a 10-year on a business like Google, like that's why the credit markets are interested, right?
Yeah. Yeah.
I mean, like if Google's not going out of business in the next 10 years, buying Google's 10-year treasuries or version of 10-year treasuries or 20 years, like theoretically, you're like, all right, build the data centers as long as we see the ROI and we don't think you're going out of business. As long as Google doesn't go to zero, we can guarantee a yield.
That's I mean, I'm looking at Google's bond right now. The corporate bond rate on this, just share the screen. So this one is all the way out to 2075. Okay, the maturity on this thing is like way out there. Because when it comes to a fixed income investor, a lot of times they'll buy and they're buying to hold and to get that nice juicy return. Like right now, let's say I have a debt obligation. Like I'd say took a 30-year mortgage, right? And I have a 3% mortgage. Well, I can take this buy Google bond, pay my mortgage every month, and basically collect this interest the entire time. And basically arbitrage the whole thing. So that's the thing about rich people. Once you get to a certain wealth level, you don't need that 5x anymore. You just need 7 to 10% and you're golden. Like if I have 5 million,
it's the beautiful part about having serious amounts of money. You don't need to take risks to make more money.
Yeah, like let's say I have $5 million and I'm getting, let's say, a 7% return, right? 5 million, that's 350 grand a year coming into my pocket.
Yeah.
Living a good life. So bonds are not bad right now. So
unless you're living a crazy lifestyle, 350 grand in Georgia, even 350 grand in New York that's pretty damn good.
Yeah. I mean, that's where wealthy people do. Wealthy people, they hand their money off to money managers. The money managers do all this shit behind, basically a good money manager will say, okay, what's the goal here? Is it capital preservation? Is it long-term compounding? Is it like, is it like, do you want to turn your 5 million into 50 million? Or are you happy? Like if I'm like if I'm my dad, like let's say I have $2 million, right? I'm my dad. I want to retire and I need a certain amount of money every month so I can live my life. I have car payments to make. I have health insurance and I want to go on vacations. I can get, let's say 7-8%, dude, 7% on $2 million is $140,000 a year. You live in a decent place.
As long as inflation isn't 6%, right?
Say again?
As long as inflation isn't 6%, because then that 7% the nominal yield on it is.
Well, that's the thing. The question then becomes, do you think that inflation is going to stay 5, 6, 7% a year for the next 20, 30 years? I don't think so. I think historically, I'm looking at this from a demographic standpoint. I think we are going to get a lost decade in the next probably like 2 to 3 years. Like, I think we're going to start to see that. And what I mean by the lost decade is that the demographics from what I'm seeing, like number one, you're not seeing a dramatic rise in population anymore. Right. So that's a huge growth vertical that's down. You've got housing, which is at all-time highs. and there's just not a lot of affordability out there. So you're not going to see a lot of home price appreciation. Or at least that's what I'm thinking in majority of the country.
AI
So-
is deflationary.
Yeah, AI is deflationary. So if we get back down to, let's say, 2% inflation, right? So that means that if you're getting a 7.5%, 8% yield, you're basically capturing the spread between 8% and 2, which is still 6% return per year. And if you think like the long-term average of the S&P 500, it's not crazy. It's like 7-8%.
That's all it is. It last 5 years makes it seem crazy, but it's usually 8 to 10% on a really good year.
There is one downside to corporate bonds, though. Even though the value says 8%, you have to pay taxes as if it's your ordinary income.
Correct. Yep.
So it really benefits
They take your
retirees.
treasury.
Right. But the thing is, if you're like, let's say my dad and my mom, together they're a married couple, if they're getting $100,000 a year, they've got massive amount of standard deductions that they're basically going to be able to take, and they don't have to pay any taxes on that. Versus, let's say someone who's, already making 300,000, every incremental interest payment is going to be taxed at 35% on the federal side, and then depending on which state you live in, another, 0 if you're in Florida, or 15% if you're in California. That's why a lot of retirees, they love living in Florida. The other thing is, I don't know if you know this, but there's certain states that are really good for senior citizens. Like Georgia, we have no taxes on, like, state taxes on investment income in retirement up to, I think, like some crazy high number. So it actually benefits them. And the other thing is, a lot of counties have it so that if you're a retiree, you don't have to pay school property, like the property taxes that are, going to fund the school system, which is usually about 70 to 80% of your property tax bill. You don't have to pay it. So I've seen houses, their property tax is like $15,000 a year on $1 million house, but because it's a senior citizen living there, their property tax is only like $4,000. Like,
makes sense.
$11,000 doesn't go. They don't have to pay $11,000 in taxes. But if me or you buy, we have to pay the full 15, even if we're not sending our kids to the school in the area.
Right, because we're not retired. No.
Huh? Yeah.
Because we're not.
I mean, it's
not older.
California is like boomer heaven because of that. Like all of these old boomers who bought their houses in like Palo Alto and everything else, bro, they use their homes as like liquidity. Like, just, it's amazing. The way that California has it set up, let's say you bought your home for like $100,000, right? Like 30 years ago. Your property tax is based on that $100,000 that you bought it at. So your property taxes is not like, it doesn't rise.
I heard about this a year ago and I couldn't believe it. Yeah, you were
versus some new guy comes into that same neighborhood, buys a house for like, let's say $2 million. They're paying taxes on $2 million. And they're still living in the same neighborhood as that old boomer who bought his house at, let's say, $100,000. And basically, that is the difference between property taxes. So the younger people are basically financing the older people's, thing. So a lot of people are getting kind of like this younger generation. They're getting really like ticked off because it's like these guys have basically come in, they've lived this amazing life, and now all of a sudden, 437. Damn, Chad, where are you getting that kind of property tax? Is that a year or a month?
Yeah, is that a year or a month, Chad? It's got to be a month.
Where does Chad live?
Arkansas.
Yeah, but did you see like Gary Tan posted this on Twitter, where he's like community meetings where they do not want any additional housing to be built, like multifamily housing in a certain area in California. Like the property costs are insane in California. And these boomers, the boomers will never allow additional housing to be built in that area because they know it'll decrease the value of their homes.
Right.
And if that happens, they can't keep running the game that they're running right now.
Well, Andreessen,
they're not really running.
Mark Andreessen also signed that letter of not having more houses being built in certain areas because like it messes the game that they're playing that you're talking about.
Yeah, but the problem is you're basically creating a system where you've got this one underclass, like the newer generation, the next generation is like this permanent underclass. which is not good because I mean,
Well,
our generation.
that's whole financial nihilism. They can't find jobs. Buying a house is expensive. Inflation's like, yeah, Gen Z, millennials. It is harder theoretically than the boomer generation, but we have the internet, we have technology, we have more opportunity, right? I guess that's the trade-off here. It's like there wasn't YouTube in 19.
They better be. I'm just gonna say they better be careful, bro. Otherwise, they're gonna get the Eskimo treatment. You know what the Eskimo treatment is?
What?
When the old people get too old to hunt, you gotta go. You gotta get there and go. You gotta get that seal blubber by yourself, old man, because we can't survive winter without you. We can't be out here feeding you. I don't know if that's real, by the way. I'm just saying that's like, do you watch House of the Dragon, like Game of Thrones?
Dude, I tried 2 minutes of freaking Game of Thrones. I got bored as shit. I was like, what is this?
Yeah.
So no.
There's this like practice in the North. Like it was a really interesting topic that they kind of brought up where the old, like what happens is, the winters in the North get really rough. So all the old men, they get together, they're called the Graybeards, and they're sent to like the war to go fight and die because that kind of preserves like the food for the winter for like the younger generation. Right. So at some point I think the world is going to turn very, very bleak for a lot of these old boomers. And I think
it's also the same argument that like, the proletariat will overthrow
rise
the
up.
rich. If like, that's the thing about this financial nihilism argument. Like people that are broke need to feel like they have a chance. If you don't feel like you have a chance, we saw what happened with that United Healthcare. What was it? The CEO last year who got shot. I mean, like shit hits the fan when people feel like they don't have it. It goes back to violence. And now morally, I think we would say that's apprehensible, but the point is that is historically every revolution we've seen a lot of times has been a class-based.
Yeah. Well, the thing is like, and someone said in the comment section, does that mean that we just like kill all the boomers? Like, no, that's not what happens. But a lot of the privileges that the boomers have right now may get taken away. Like, here's a couple of examples of like things that they have, like Social Security. The way that Social Security works is that you pay 6% of your pay, and that goes into the Social Security Trust Fund, right? And that Social Security Trust Fund, they basically get paid. Our generation, basically, Social Security is probably going to be bankrupt by the time we get there. That means that it's not that we won't get money. It's just that like the benefit that we're going to get is a lot less. Now, one of the reasons why that's happening is because, do you know that Social Security is capped at a certain income level? After that, you don't pay more, right?
Yep.
So that disproportionately benefits people who are making $300,000, $400,000, $500,000, $600,000 because they're not paying anything incremental, right? But at the same time, someone who's making 100 is paying the full 6. So you may see that disappear in the future, and Social Security might not have that income like thing anymore in order to preserve Social Security for the future. So, or that cap might be raised significantly higher. So not only will you pay that higher amount in federal, but then you'll also have to pay this crazy amount in Social Security. And that Social Security may not be something that ends up getting collected. All it is just a stopgap to get the thing to the next level. I mean, the other challenges, and this is the one that's a little bit more bleak, you might get a lot of cuts to Medicare and Medicaid. And the thing is, like, if you just look at like the amount of money that we spend on Medicare, it's like, I think like almost a third of the budget. Like if you pull it up, it's crazy. And the thing is, all of that money is going towards taking care of old people, right? So at what point do you say we need to start cutting back on Medicare because, we just can't afford it? Like, you want to bankrupt the country to take care of 89-year-old grandma with a broken hip?
Yeah, it's tough because there's a lot of moral conversations that pop up in that as well. And I thought Doge was kind of the solution to it in a naive way, but I mean, obviously that's not changing anything. This is one of the stocks I want to show. Our boy Triple V. This is a REIT, AGNC. A lot of people might know it. He got this thing at like
I know it very well. Yeah.
Pays basically a 14% yield a year. He's getting $800,000 a month off his AGNC, just coming in every single month. And that's, and obviously he's an active investor in tech stocks, but it's like,
Yeah.
To get a cool 800 grand guaranteed, and you have you're up on the principal because you have
Well,
that much money to put in the first place.
It's not guaranteed. It's not guaranteed. Just
Well,
let's
yeah,
take a
that's
step
fair.
back. But it is very. They've been around for long enough where they have a lot of controls built in. They do a lot of something called mortgage-backed securities. So basically, you know, they buy all this mortgage-backed securities, they layer on some leverage, and they're able to generate a crazy amount of return from that. So, but you have to know what you're talking about when it comes to like mortgage-backed securities, and there are some that took a massive hit during 2022. So yeah, so just be careful with those.
Yeah. Again, it's the journey for why we're all here every day, right? Trying to generate that capital, that financial freedom. There's also a level of personal accountability that everyone has to take to get there too.
Someone brought a very interesting point. Said AGNC is on a 5 year is down 33%. Yes, you have to be very careful when it comes to certain dividend companies or dividend payers or whatever you want to, or MLPs and REITs, because there's two parts to it. There's that yield, but then there's that underlying asset base. So that's your net asset value. And the thing is that net asset value can fluctuate up and down depending on the conditions in the market. So, you know, if you have a bunch of bonds that are yielding 4%, the net asset value on that 4% bond is not going to give you 100% right now. It's probably going to be closer like 80 cents, maybe even 60, 70 cents on the dollar. But AGNC benefits because if, let's say, interest rates start getting cut, that means that the bonds and mortgage-backed securities that they have will actually go up in value. So then you're collecting a 13% yield, and then at the same time, AGNC goes up. So you'll collect not only that dividend, but then you'll also collect the increase in NAV. So basically it goes up. So it just depends on what, you know, what we have. So
Palantir on Monday, last topic. What do you think, Chris? What are we gonna do? You think it's gonna be a good one? You like SaaS? Streets expecting 1.8 billion.
I didn't say all SaaS.
But you can't not like Palantir if you like SaaS. Like, it's the greatest SaaS company there is right now. You know that. I know that. We all know that. You might not like its valuation, but it's still the greatest SaaS company that's out there. Dude, they're going to be doing half of ServiceNow's revenue next year. In 2 years, they'll be flipping ServiceNow in revenue if ServiceNow keeps its growth rate. Like,
okay.
Just
saying. We'll see what happens. We'll see what happens, bro. There's a lot of time on our hands. We'll discover what's going to happen. My question to anyone who's in Palantir is, do you think that OpenAI or Anthropic are a threat to their business?
No, dude. I really don't, bro. I think I explored this argument a month ago. I think this is the worst argument on Palantir.
So this FDE bullshit that all these guys are coming up with, you don't think that that's a fun, like functionally working? I saw the Karp interview. That was awesome when he said, did you see what he said about the FDEs?
What, during my interview or the CNBC thing?
No. He was doing let me just bring it up. It was on Twitter. I just saw the interview.
You mean the all hands with the company? Yes.
That shit was awesome.
Let me pull it up. You're talking about I know which quote you're talking about. I know which quote. I'm gonna pull it up. But like, I think Karp has been right about the FDE thing for a while. And I think the rest of the world is realizing Anthropic and OpenAI don't know how to actually deploy software in an enterprise and meaningfully deliver results. They know how to sell the token. Like, that's not a hard argument to get behind at all. It makes sense.
Yeah, I think Karp is probably going to be proven right in that businesses are not exactly going to be trustworthy of Anthropic and OpenAI. I just can't say whether or not the market will appreciate that in the short to medium term, you know, and they might see any slowdown in growth and basically say that this is a sign that Palantir is getting disrupted, quote unquote, or their business model is getting disrupted. I'm not sure that's real. I'm just saying that that's what the market might say. So that's the risk that you have.
Okay, let me get this clip. You're talking about the
I have it loaded up. Hold on.
Oh, you have it loaded? Oh, perfect. Oh, you show it then. I don't understand. Okay.
I have to find that one section where he
Well,
says it.
that's what I'm looking for. I'm trying to find it as well.
Does anyone know in the chat? I think the chat is pretty good. Chat, do you know which part?
Dude, I saw this clip. I know exactly which one you're going for. That was good. I'm happy they posted the all hands, dude. It was nice to see Carp in his element speaking to everybody. And explaining it in the way that he is.
You know what's interesting is that there's so many companies now doing the FDE model. Like when Palantir was,
it's not easy to do that. Like that's a hard thing to replicate.
No, what's interesting? No, the part that I find the most interesting about it is that when Palantir was doing it, everyone said this is a consulting business. Now every SaaS fucking vendor is doing the same exact thing, and now all of a sudden it's not a consulting business anymore. It's just a standard practice among SaaS vendors. Literally, like 2 years ago, the bear argument was that oh, this is a consulting business, and now all of a sudden this is standard practice. Like the market just completely flipped on the FDE thing. Did you notice that?
Yeah, I know. I remember making videos about the consulting FDE thing in 2022, and it was just like, no, it makes sense. You send the smartest people to the enterprises to actually deliver and build the stuff that makes it valuable. And everyone thought it was Accenture. It's like, what are you talking about? They have 80% gross margins. What are you smoking? Chad, your link goes to the full thing, not the part that gives the quote is really good. I don't want to say the quote. I want people to hear it from Carp. Where's this damn clip? I'll play a different one first while I'm looking for it.
Burry's still shorting this thing, right?
No, I know.
He
covered part of it short. He covered part of it.
Did he? Okay.
Yeah, when it went to 107, he covered part of it.
Damn it, man! Where did it go?
Here it is.
You found it? Okay.
Okay. Shout out to John with the clips.
This is a global movement, and so the hard part about talking to customers is it's a global movement that they understand is needed. It's a global movement that we are the leaders of, without doubt. We're going to stay the leaders also because just like with PG, we are fully aligned with the customers. We actually want the customers to succeed. We actually get paid. We are the only company.
Anthropic and OpenAI don't get paid when the customers succeed. I mean, that part is like they get paid by selling more tokens. I think he's so right about that. And that's why I think culturally, Dario and Sam don't know how to gear a company to results or outcomes. It's to margins to go IPO. That's why I think the whole replacing FDE model is just going to fail horribly for those companies.
Well, I think they need a quick hit on growth to justify their IPO. Yes. I think that's the other thing too. Like they created this FDE thing overnight because they saw that, like, look, if the market,
because the token costs are going down, so they have no margin.
Yeah, exactly. And the thing is, they need to show growth. So if they can't show growth or they can't show a sustainable business model, they're basically gonna get cratered. So sorry, they're trying to do what Palantir does and replace it. Go ahead, you can put it back on.
And definitely the only company at scale that actually is paid as a derivative of value creation for the enterprises we work with and serve. We do not have any other way of actually getting paid. Every other company wants to outsource the risk of failure to the client because they know it's going to fail. Because to succeed, you would need a full stack from compute all the way up now to model training. And you'd have to absorb the risk of that not working, which means having some kind of business intuition about what the value is to the customer, a willingness to say no, FTEs that aren't just masturbating and selling tokens. It's like that's what these deploycos are actually doing. They sell tokens. The FTEs that some of them are ex-Palantirians, they're just selling tokens. Just like some of you guys had a social life in high school that was virtual, except for you're ripping off the client. Yeah, and so that's what's actually going on, and the clients are tired of that. If you do that on your own time, that's their basic view. Don't show up at my company and do that. While migrating the value of the enterprise to your company and being very unlikable and leading to a wealth tax.
Chad says, I didn't know this, Chad. We planned that 4 minutes ahead of time for the all hands.
Yeah.
Just handed him a mic and sent a note to the whole company.
You do gotta love Karp and his way of thinking ahead of things. Like, I used to give Karp a lot of crap about being a philosopher and maybe not being like having that tech background. But I kind of see that you kind of need a little bit of just trying to understand dynamics that are way beyond just technology and like learning more about human psychology, and basically utilizing some of that into it. Like, I mean, I'm probably saying this because when I saw this whole thing with token maxing, that's exactly what I thought. These people were giving out awards for, we spent $1 billion because not a billion, sorry, you spent 1 billion tokens. Here's an award. And I'm like, what kind of stupid thing is that? Like, the award that should be given is, listen, we gave you 1 billion tokens and you created $1 billion company out of it. Like, that is what you want. You got ROI.
You increased margins by 2%. You decreased cost by 5%. Like something tangible,
right,
to the tokens.
Not just, oh my God, you were imagine the power company comes out and says, oh my God, you would use the most power in the neighborhood. You get an award. Like that doesn't make any sense, Just because I ran my AC units cooler, like, come on. Like, if anything, you should be giving awards for, listen, you kept your house cool all throughout the summer and only spent X amount of dollars. That's the award,
But see, this is also where age, when it comes to analyzing stocks, is important. When I started analyzing Palantir, I was 23, 24, and the naivete of philosophy and all that stuff was really intriguing to me, which is why I gravitated towards it. You've been through shit, and you're like, I don't give a fuck about philosophy. Show me the numbers, right? And the numbers weren't there in 22 and 23. And so and we see the Leopold situation being too young and you don't understand how to manage risk. It all comes down to like how you can find perspectives that allow you to see the next level of where something is going, bad or good. And I think with Karp, if he was a super technical AI guy like Sam Altman and Dario, like no one likes listening to them at all.
Oh yeah. They're dude. I don't think I've ever met anyone that's so unlikable, bro. Like,
and they're leading the most important revolution of human history, and no one wants to hear from them. Whereas Karp going viral on CNBC, like hundreds of millions of impressions, that's because people actually agreed with what he said, and the customers are feeling it.
Not only that, but when Dario comes out and basically tries, like, look, when they did this whole thing with the regulatory capture thing, I wasn't disappointed in Dario because I knew that is exactly where you need to go. Like, the model layer is going to get commoditized. So you're going to try to do that, but at least do it in a way where, like you're not overtly like giving everyone the freaking like thing and basically waking everyone up to it and basically making them hate you.
Yeah.
Right. And you have to also have some give back as well. So I think the thing is, like, sometimes in leadership, it's not just about technical ability, but it's about how you communicate the message to the point where you're not going to have a crazy amount of pushback on your specific business, and I think Anthropic is failing at that right now. So we'll see what happens.
I agree. And when Karp talks to the customers about actually getting results, that's what they want to hear. When he talks to investors about actually producing meaningful outcomes in the enterprise, that's what they want to hear. When he talks to his employees about, hey, you could go join OpenAI and Anthropic and produce better models to just sell tokens that ultimately don't do anything. I talked to two engineers who just joined Palantir 5 months ago, and they were just like, dude, this is the only place we could imagine working. Because again, some of these kids are the smartest kids in the world, and they want to do some shit that when you're that smart, you want to be involved in a mission, and I think as a CEO to galvanize all these different types of stakeholders and have them feel what you feel, and then to produce the business results on top of that, right? Like, I think they're going to grow close to 90% next quarter, hopefully.
I'm going to bring something up. I read Burry's bear thesis on Palantir. And basically, one of the things that I think he took it as a negative, but when I reread it, I thought of it as kind of a positive. One of the negatives that he highlighted was that they had already existing products that when the AI revolution came around, like when 2022, when AI came, they basically, saw like, oh my God, this thing is actually going to be a really big thing. And they reworked some of the products that they had and made it like AI native. I think the one that he was talking about was Apollo. I think Apollo. I'm not sure which one. I have to read his Substack again. But basically he highlighted that, saying, look, all they're doing is taking old technology, layering on like AI verbiage and selling it to customers, saying, oh my God, we're an AI company now. And the thing that got to me, to be honest with you, was, yeah, that's a fucking great business strategy. I don't know why that's wrong with that. Like, if you have something, you're able to take AI and put it on there and sell it. Like, isn't that what you're supposed to do? You're supposed to freaking, like, as a business, like, flip your entire script right away. What are you going to do? Like,
yes, but also I think Burry misunderstood. Like, the ontology was the missing piece of AI. Like, so if they remarket it as AI and it's central to making the models make sense, that was the whole KLLM thing, which was the earliest iteration of how the ontology would work with LLMs back in 2023. It's like, yeah, that's why they're growing. That's what's not going to be commoditized. I feel like his entire article missed that key point.
I saw something funny on Twitter. The number of people saying ontology now, like there's actually businesses right now. There's like a company called Ontology AI. Did you see that? Yeah, Ontology AI. One second, let me pull it up. It's a very interesting development that just came around. Like right now, let's see.
Oh, I see it.
You see it? You found it?
Dude, what is this shit?
Yeah, show people.
Ontology uses machine learning and graph databases to help high growth startups to find the best talent for growth.
I'm telling you, it's all over the place. Like ontology is like a thing now. That like some people are actually talking about it. What's funny is like 3 years ago when people saw ontology, it's like, what the hell does that mean? Well, now here you go. It's not called ontology. They call themselves Onton AI right here.
Oh my gosh. We can't hear it, but Onton. Well, I'll just go to the website. We don't need to hear the thing.
Yeah. If you want to pull that up.
Let me go to the website. Wait, Onton AI?
Yeah.
Onton AI? Are you sure? It's
Yeah. It's Onton_AI. Onton.com if you want to go to the website.
Onton. This is a oh yeah, you're there. This is a shopping website. That's why I was like, are you sure?
Yeah. High performance experimental self-learning model. Best for complex searches.
Dude, they're definitely calling it the ontology because they know it's a popular word right now.
I mean, it's working. It's got almost 300,000 views.
I mean, bro, but ontology is a word that goes back hundreds of years. It's defined as the state of being. So philosophically,
yeah, but bro, I've never heard ontology before Karp mentioned it. Like I don't think anyone.
Oh, that's my point. Well, I did. That's why when I heard Karp mention it, and I was like, who is this guy with his hair talking about a word that I used to study in debate class? You know, that's what really intrigued my attention. Yeah. And it happened to be a philosopher who was using that word in a philosophical way to describe the data infrastructure, the state of being of the data in your organization.
Yeah.
I mean, it made so much sense.
I think Databricks is also doing FDE model now too. I'm telling you, man, everyone's doing a goddamn.
Bro, everyone, because it's not easy to just be like, okay, buy our software and then it's going to create results. Like you kind of need some help to make it make sense, to get those reoccurring subscription revenues to come in.
Yeah, take a look. Look at this. Databricks is launching forward deployed engineering to accelerate. I mean, at least call it something else. You know? You know, it's such a cool name, but at least try to call it something else instead of like rip it off Palantir's like model.
That's the problem. The FDE has become such a term of art that I think people think it's easier to just tap into the term. I mean, OpenAI, I think it's called Frontier or something. They came out with a forward deployed engineering thing as well.
Really?
Yeah.
I don't know. What else? What if you were one of these companies and you didn't want to use FDE, what would you call it?
You can't call it like it's not something that's related to services. That's why there's engineer there, right? Because it's a very engineering heavy implementation.
It's such a perfect word, dude. I don't think I don't think you could use another word to get like a better encompassing like thing. Like help us solve our business problem. Like that's their job, basically.
Yeah.
One more interesting thing before I go. There have been.
By the way, Chris streamed today. I think this whole bond discussion, a lot of people seem to appreciate it. I thought it was good stuff. Also, we always need the bear case. You need someone to be able to articulate it. So I think it's important. But the bond stuff is very interesting.
I'll give you some kudos. I think I appreciate the fact, and same thing with all of our friends, like what's his name, Steve and Tanner. I do have a lot of controversial takes sometimes, and they're never just like, oh my God, everything's gonna be great, right? But the thing is, you guys keep platforming me, so I appreciate that. Because theoretically, y'all can say, yo, I just don't want to get Chris hate any. I don't want any more haters on this channel, but I also bring a lot of value, in my opinion. I bring value.
You have to hear the other side. You have to.
Yeah.
Like, it's just like, I'm so happy Camilo said that today. I get so annoyed when people don't want to hear the bear case. It's like, because I pride myself on the show every day of presenting both the bull and the bear case of this whole AI thing. I don't think anyone who watches my show can be like, Amit's a permable. Because there's many times where like, is Amit like bearish on this? And I'm like, well, look, my general premise is to be more bullish. That's who I am. That's my investments. Long portfolio reflects that. But I'm not going to not look at all this OpenAI backstop thing from NVIDIA, 250 billion. That is concerning, 100%. And if you can't analyze that and give that analysis to people in the morning and let them drive their conclusions, then what are you saying on the stream? Just like, oh, everything's great, everything's amazing. Like, no, you have to have perspectives there. So
yeah, like I said, I don't get everything right, by the way. I don't get everything wrong on the way. I think it's, I don't know of anyone who's got everything right. And like I said, I don't have enough, what is it called? I have enough humility to admit, like, when I get something wrong, I get wrong. Like, for Palantir is probably one of my biggest regrets, only because when I saw that revenue start accelerating, I ended up just saying, you know what? How much more could it accelerate? How much more could it accelerate? And that shit just, and now I'm too far into my like cautiousness.
Into your bearishness. To answer your question, Chad, yes.
Yeah.
I would like that. The only part, I think, Chris, where you went a little too far on Palantir is when you said Karp, you don't like his watch. That's when I was like, all right, bro. That's like, we don't
what it was?
He's a billionaire. He has a fucking watch. Like, who cares?
No, I got pissed off because I was just like, oh, this guy, like, stop winning. Just stop it.
Your hate took over that day. I get it.
Yeah. Stop winning.
Look into the lab's revenue from distillation. For the Frontier Labs revenue. You might have to give us some more hints on that, Chad, for us to dive into that. Trump considers U.S. strikes on Iranian energy targets with coming days. Axios proposed attacks aim to pressure Iran into accepting ceasefire negotiation terms.
I mean, how can we see that? I thought that's behind their S1.
Wait, the Frontier Labs revenue? What do you mean revenue from distillation? You mean the labs are distilling the models? Aren't they the ones getting distilled from China?
I mean,
he might have given us a rabbit hole to dive into.
Shit, man. Now I'm gonna spend all weekend thinking about this. Thanks, Chad. Frontier Lab.
Hold on. OpenAI revenue distillation.
Frontier goes dark.
Yeah, I'm seeing every headline saying their revenue is threatened by model distillation.
It is, of course.
I mean, they're the ones that are distilling.
Oh yeah, dude. There was this guy on Twitter. His name is Andrew Ho. He's a former OpenAI engineer. He basically blew the lid on this whole thing. Did you see it?
No.
Yes. Okay. So I just followed him today. He basically, this was his thing on X that he posted. This guy. Okay, so this was his last day at OpenAI on July 29th. And basically he went through everything about like the bear case on the labs. He basically said, like, I'm stuck with this $700,000 worth of equity in OpenAI. I can't even get out of it. But basically, yeah, it's pretty damning. So you have to go through it.
Well, hold on. There's a Chamath tweet that corresponds with this. Let me pull this up. Oh, wow. The person who posted this deleted their tweet, but Chamath didn't delete his quote. So this person said, and they deleted it. This was today. Oh shit, this was today. Damn it. It got too much attention for them to have deleted it. I have a screenshot. I suspect 1/3 of the current Anthropic revenue is distillation China, which will eventually go away and margins compress, which moderates the $1 trillion case. That's all I have of the screenshot. Chamath says, I heard secondhand that situational awareness's Anthropic position was marketed but went unsold. Is this true? Why, if accurate, is no one reporting why nobody bought the private position? What does smart public money think of valuation? Is the below comment, which is now deleted, common knowledge? Could it explain part of the reason why folks passed?
I heard they went to Sequoia and some of these guys, but from what I heard, the offering price was not great. And so what happened was the deal did not go through. Like Thursday morning is when like this thing blew up, right? So Thursday morning they withdrew their offer basically. But there's some shit happening. There's some shit happening, bro.
This was the lady who posted the tweet and she deleted it. This was today. Yeah. And again, she said, I suspect 1/3 of current Anthropic revenue is distillation China, which eventually will go away. What does that mean though? 33% of their revenue is. How is Anthropic making money from distillation? Is Anthropic letting?
No. Okay, so yes, so Chamath brought this up. And Chad, you're gonna have to give me some rope here. The revenue that like OpenAI and Anthropic they're collecting right now is coming from all of these accounts, like black market accounts that are logging in and basically running queries. And now all of a sudden that data is coming in and the Chinese are basically distilling all of that shit, right? So now what OpenAI is saying is, look, everyone is saying, oh my God, I've got this ARR. I got this ARR. What's the fucking Chinese coming out there and basically buying black market accounts to do that?
That's still revenue for OpenAI if they're distilling it.
Yeah. But here's the thing that OpenAI and Anthropic are kind of screwed with, because they can do something called Know Your Customer, where you have to like upload your driver's license or something, so that this way that data can't go back to the Chinese for distillation, right?
Right.
The problem is if they did that, then automatically their revenues would go down 33%. And now...
Oh, because the Chinese bots... Okay, because the bots... Yeah.
Because then the Chinese couldn't distill you.
Yeah, that's true. I don't have to show my driver's license to make a Claude account. It's just Gmail.
Yeah.
That's it.
Well, that's the thing. A lot of people in India, that's what they've been doing, by the way. I don't know if you know this. They've basically been opening accounts and selling it on the dark web, and basically all the AI labs in China are buying these dark accounts, using it and distilling the thing. Now, here's the clever part. Remember, if you're on like a Mac subscription, you are basically killing it in terms of like the amount of compute, right? You're not actually paying that API cost. So,
you know what's funny about this as well? Our mutual friend Rango, you guys know him. Rango does a lot of VC stuff. He texted me yesterday. He said, "Dude, I have a block of OpenAI that I can't sell. Like I have 25 million of this shit. I have 25 million of OpenAI that I cannot sell right now." And he's like, "Do you know anybody who wants it?" I was like, "I don't really know someone who's interested in OpenAI right now." Like, and a year ago, a lot of people wanted OpenAI. Like a lot of people. A lot of people wanted.
Daddy Jensen coming in to backstop this thing, worst freaking like signal ever, because that means that OpenAI couldn't raise the fund themselves. Yeah, 30% of your revenue, that'll eventually kill you. Absolutely.
Now that actually is a rabbit. Why was that tweet? Who is this person? Why did she delete this tweet? And what was her source? Someone at Anthropic tapped her shoulder to delete that tweet. She's
not only that.
She's also who is she? She's not like some big tech person. Oh no, she has a fund of $250 million. Okay, no, never mind. That's kind of important.
Yeah.
Okay, so she's in the Valley. And
take a look at this. The other guy, Andrew Ho, who's that former OpenAI researcher, this is what he posted. And he did not delete his shit because he's already out. Many people claim that labs have high margins, yet even with high margins, a valuation of 1 trillion would be justified only if the labs were doing nothing aside from serving inference, thus reducing costs only to those relevant to inference. Posting annual revenue numbers in the $100 to $200 billion range, assuming 80% gross margins and a 20x in earnings multiple. The assumption is obviously not true because the frontier labs have to continually spend money training the next generation of models. This is because the market competition from runner-up firms, for example, if OpenAI had paused model development last year, there would no longer be any point of anyone paying GPT-5 API prices when you could just use Quinn or Kimi instead for much cheaper. Thus, the labs are forced to invest ever-increasing amounts of money into model training in a way such that any given point in time, the amount you're forced to invest in the next model is dramatically higher than the amount of money you're actually making, because even if your revenue goes up with the higher model capabilities, so does your future training costs. This is profoundly punishing dynamic with severely penalizing.
And this is an ex-employee, OpenAI employee.
Yeah. Yeah. I mean, there's a bunch of articles that came out with the exact same thing right here on Fortune. See, he's like, I'm sitting on $700,000 worth of equity that he says is overvalued. OpenAI researchers are coming out and saying their equity is overvalued. That's gangster, right?
Bro, there's a lot to dig into here, folks. I mean, it's not crazy to imagine that a ton of that revenue is indeed coming from these Chinese bots that are distilling the models.
Yeah. I mean, dude, do you notice how quickly the Chinese models come out right after like their newest models come out? I mean, the gap used to be 3 months. Now that shit is like getting cut by so much. I think there's obvious distillation happening for sure.
That is dude. And the thing is that S1, that's going to be the number one question. Who are these billion users? Who are these billion people that are using your platform every day? You know,
and where are they coming from? And who are the businesses paying that API when they can literally go to a cheaper API and get literally frontier level intelligence? The problem is not everyone even needs frontier level intelligence. Like, did you see the thing with DeepSeek V4 Flash today that came out?
Yes. Yeah.
That it was crazy. This is just benchmarks. Okay. So this is not real world use cases, but they're selling the tokens at like 90%. I mean, like not 90%, I think 90 times less than what Anthropic is selling. And if you look at the benchmarks, they're like neck and neck. It's not like a crazy high value that you would want to pay for it. So sovereignty making
yeah. Like, if you're a business giving your data into this pile of shit,
and then the Chinese distill their fucking shit, you're basically giving the Chinese a leg up. Oh shit, yeah, that's not good. That is not good. But you know, that's what Jassy also mentioned on the call too, though. Did you see that? That the businesses will train their own models. They're not gonna.
Yep.
Yeah.
No, that's fair, and that's part of the reason that Trainium is also becoming more and more important.
Yeah,
dude, this is quite the wrap. Because now here's the thing. If it implodes OpenAI and Anthropic, and this is going to Chris's bear case, kind of implodes a lot of the semiconductor stack, right? I don't think it implodes the Max 7.
It doesn't implode their stack. No, I don't think it implodes theirs. The thing, but the fear that OpenAI and Anthropic valuations are overdone. So now all of a sudden that bleeds into
Micron,
so what the hell did No, it bleeds into Google, Microsoft, Amazon valuation, because now all of a sudden they're like, wait a second, how much of your RPO is coming from these assholes who may not survive?
But if those get hit, the semis are toast.
Right. Yeah. But then also you got the hyperscalers that are probably going to take a beating, because all of a sudden now their equity gains are not really real equity gains.
Yeah, I mean, the only way that would make the semis fine is if OpenAI and Anthropic are just the Leopold of the AI industry, the leverage that needs to get the fuck out. and you have this diversified open source model stack ecosystem, you obviously still are going to need more memory and chips and all that stuff. It's just not going to be centralized with RPO for compute or purchase orders from two companies that they're not going to go belly up, I would imagine. They're just not going to get $1 trillion valuations.
Yeah.
Which means, yeah, they'll still probably keep spending on compute, but the day this becomes like mainstream or like the revenues fall off a cliff because it was all Chinese bots, that day will be painful for the whole market, even if eventually.
I mean, did you see this post that I put on Twitter? Like, I was wondering what the hell happened here. I think some of it was OpenAI, but I don't know, man. Let me see.
Yeah, if everyone has to train 10, 100, 1,000 of their own task-specific models, hosting then bullish semis, and then that ultimately becomes bullish compute and the cloud providers. Yeah. It's just OpenAI and Anthropic. Every time I come up with a bear case around all of this, it goes to hurt them the most. There will be residual impacts across the entire industry, but those are the ones that are like the ones that are, and those are the ones that, what do they sell if they don't sell tokens? Because Micron will still sell memory, but are you going to sell home speakers if you're OpenAI, right? Like, is that the plan?
So everyone kept like showing this thing. We're like, oh, Anthropic's revenue run rate is $74 billion. I'm like, do y'all know how revenue run rate these guys are declaring? What they do is the last month's worth of revenue, they take that, multiply it by 12 and say, oh my God, this is our revenue run rate. And it looks great. It's amazing. But if Chad, if what you're saying is correct and the distilling is happening, at some point, if the distillation stops, what's going to happen to that revenue run rate? And what's interesting is, look at this. Their run rate from January was like spiking, and all of a sudden it started to kind of slow down here. So this was
that's where the Chinese models in the past 6 months. And that was token maxing. In the past 6 months was Quen and Kimi potentially distilling.
Yeah, the question is, what's going to happen then?
That's an interesting topic to dive into.
The other thing that's not very confidence inducing, OpenAI reduced their tokens on some of their
I saw that
80%.
I saw that. Dude, it's a fucking commodity. They have to compete by lowering the prices.
Or they need to sneak their FDEs into your organization and build a freaking monster that does nothing but eat tokens, even if it doesn't provide you any value. Because that is what they're going to highlight in their S1 as a business model. They're going to say, we are going to own the enterprise AI market, and that is going to be reoccurring revenue from token consumption. And our estimates are token consumption will go up like 100-fold, and all of it's going to come to us because we have the best models. Instead of, we have the best outcomes.
So we're buying pounds here, right? That's the conclusion. I mean, dude, this is just... couldn't they really go public with an S1 that says, buy us because we think we're going to sell more tokens? Like, I don't know how many sophisticated investors are going to look at that and be like, but why? Why would we pick you out of all of them?
Especially I don't know, bro.
Especially when China has better models every other day. Like, $1 trillion, bro? Like a couple $100 billion, like $1 trillion?
I want to know what Sam Altman and Dario sleep score is, bro. That's what I want to know. Because that it will give us an indication on what the S1 is going to look like.
Dude, and that's a good point. If they go public with this bullshit, there's no more SaaS apocalypse.
Yeah.
Because the market will sniff all this out and be like, oh, the actual value is going to the companies that are just using the commodity of the model to produce business results. And if OpenAI and Anthropic can't actually produce those outcomes, what's there?
Yeah. I don't know, bro. I'd say we've got to be very careful, dude. And I think Elon's another threat that no one is taking into consideration. I think if and when OpenAI goes public, Elon is going to crash them, bro. Elon is going to just rail at them hard.
How?
I don't know, but I'm telling you, Elon hates Altman. The thing is, Altman is not public right now. So whatever Elon says doesn't really matter. But if OpenAI is public and Elon starts coming out and saying shit and scaring the shit out of people, bro, OpenAI is going to take a deep, deep hit. So just saying, be careful. And if Elon has to go broke, destroying Sam Altman, he'll fucking do it. He'll do it.
Elon has a lot of resources to throw at the wall.
Yeah.
He wants to compete with them. Yeah.
Yeah. I mean, XAI, as small as they are right now, and no one really uses their stuff as far as I know, there could be something there, man. There could be something there. Like, I'm not a fan of the space data center thing because I just don't know if it's real yet. But if it becomes a real thing and this guy owns the compute layer from space, hey, could be a real business. So we'll see what happens.
All right, folks. Thank you all for joining. Chris, thank you for staying longer. Hopefully this was a intriguing Friday stream. Definitely got some different
we
perspectives
gotta
out there.
talk to Chad and figure out. Like, I was talking to Coach Strap too. He gave me the lowdown on a lot of things. He's like, bro, this ain't gonna work as cleanly as people think it is. So good
There's
times.
a lot of different versions of how this could play out. I think that's the thing. It's not just, I mean, Leopold found out this month. It's not just up and to the right. Like, there's different nuances to this shit. It's not as simple as we're compute constrained. Like, we have to go deeper into what's happening here.
Yeah, not only that, but we also have to recognize, like, there is a serious counterparty risk that the market may or may not be taking into account. I mean, I think the market is. Otherwise, you wouldn't necessarily see the bonds on Oracle trading as low as they are.
Yeah.
That's not a good sign, to be honest with you, because when you think about it, they're tied to OpenAI's equity valuation. So if the bond market is turning around and say, you know what, we don't trust that this RPO is real, we're going to discount your bonds. I mean, what does that mean?
Yeah. No.
Yeah. Good times. Good times.
Siraj, thanks for the super chat. Chris, thank you for being on. Appreciate you all. We'll see you guys Monday. Market open.
Later, dude.
We are entering the month of August, and we will analyze everything we have to analyze for the month of August. Thank you, everybody. Appreciate you all. See you guys on Monday.
Take care.